India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a fresh new week. It's, of course, the week where there's a market holiday as well, 15th of August. So holiday shortened in that sense, but there is a lot to track in terms of what's left off and what we carry over into the new one. And, of course, new cues as well. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Mangalam is here with us today. Guys, hi, good morning.
Good morning. You know, if you saw the market on Friday and you saw what happened all of last week, you wouldn't believe what happened on Monday already. So it was a volatile week, but ended well.
Yeah.
Now, again, on Monday, there is always some sort of volatility that starts on a Monday. Towards the end of the week, everyone's digested all those news. So we start with a fair amount of news on Monday.
Well, bulls will be feeling good on this Monday in comparison to the last one.
Yeah.
And the other good news is the Japanese market is shut as well.
Right.
So the troubled one is asleep for now. Let's see whether or not we can build on the gains, because now the bulls are feeling much, much better in comparison to what we saw, say, on Monday evening.
I mean, actually, it's quite incredible, guys, that I was looking at, some of the markers for stress in the system. They've all basically gone back to where they were on the 2nd of August, which is the Friday last. Not the last Friday, but the Friday before that.
Yeah.
So, things have kind of evened out. Not that, I mean, it's all clear and it's all sort of absolutely fine. But let's just quickly begin with what you need to know as we begin another week, actually. So after all of that volatility that we saw, and by the way, last week was a big, big week, right? I mean, it was crisis grade in some senses, especially that Monday and Tuesday, up there with 2008 and 2020, especially if you looked at the implied vol across markets, across currencies, etc. So there was no doubt that this was really big. It was very short-lived, but it was big when it happened. But after all of the volatility, if you look at what the S&P 500 are at and what the Nasdaq are at, they are on the last Friday. They left off around or exactly at where they were on the 2nd of August. 2nd of August is when you had that US monthly jobs data, which sparked this fresh panic. I mean, the JPY thing was coming, and then it kind of accelerated and snowballed with the US jobs data. So Friday to Friday, you essentially are at the same levels. The wicks will come up on your screen, the one before this, and that is at 20.37 last Friday. Guess what the price was? The 2nd of August, 23.39. So you're actually a little lower on the CBOE wicks. USD JPY, it left off at 146.63 as opposed to the previous Friday when it was 146.54. Now, of course, I mean, for the JPY, it started falling from, I think 155. So it's basically still higher, much higher. The yen is much higher. If the week is the timeline, then you're basically back at the same kind of level. So and on Friday, the stabilization continued. So markets stabilized. It was a quiet Wall Street session. Now I'm talking about just the last Friday. Equities steadied as well. So the S&P was up about 0.5%. Nasdaq was up about 0.5%. The 10-year, it lost about 5 basis points. We are back under 4%. I mean, just under 4%. But we've been there, about 3.99 and around these levels for the last 2 or 3 sessions in the U.S. now. The focus in the U.S., although, people have pulled back a little bit from sort of calling a U.S. recession and, the growth scare is a little less now. But I think, a lot of the focus will still be on these things. So U.S. consumer data in the form of consumer earnings and retail sales, and then you get the core CPI. But I think the more important thing is going to be the health of the consumer, and the former will sort of overwhelm the latter, which is the CPI itself. I mean, the inflation numbers itself. So in a way, what is more important in that sense for policymakers is the economy and not inflation so much. Now, Fed speak in terms of what Fed officials will say, and there will be lots of it sprinkled through the course of this week over the next 5 days, will be important to follow in terms of how they are looking at all of this, because at the end of the day, it's the Fed reaction function which will matter. Circling back to what we are likely to see here, I just want to sort of leave you with some levels. The Nifty resistance is 24,625. I mean, so far we were looking at the retracement of the entire rally. You're now looking at the retracement of the last decline that we've had from the all-time high to the recent swing low. The 61.8% retracement stands at 24,625. we left off at about 24,400. So, I mean, that's about 200 points out. Support for the Nifty is the sort of low we had the day before yesterday, 24,079, which must be defended. Bank Nifty managed to have a close above the hourly averages, which we saw on Friday. On the way up, there are two levels in terms of resistance. The 40-day exponential stands at 51,055, and then you have the 20-day moving average, which is 51,337. And supports come in on the way down at about 49,659, which is essentially the swing low for the market. I mean, I think the GIFT Nifty is indicating an absolutely quiet kind of a start, 30 points lower, and I've been saying this, I think, since last Wednesday, the bulk of the panic, I think that is kind of behind us. There is a lot of talk about this Hindenburg report, which has come through over the weekend, etc. And we will see, how that plays out. But and I've been at the margin seeing people and hearing sort of market commentators say, well, it could have a 2-3% kind of an impact and this and that. I don't see any reason why that at the margin should be a new sort of, stress point for the market as such. We'll talk about the news and we'll talk about the implications of that as we go through the course of this show. But from a market standpoint, I think, we are going to sort of trade off the cues, both global and local, and not what came out from this report, which, of course, was on over the weekend. So I think that is a live issue, but not so much for the market as such. Guys.
Well, that's right. I think if you get a bit of a dip, that dip needs to be bought into, right, going by the current structure and going by all the data points. And now the bulls, from looking at defending the lower levels of around the 50 DMA, now all eyes are on the 20 DMA, and they'll be looking to climb that particular level. So that's going to be an important cue that we are tracking. HDFC Bank, that's been a relative underperformer if you look at it over a longer duration in the last 18 months or so. But in the last 10 sessions or so, well, that's been holding its own. And that's been the big outperformer, actually, as the markets have been brittle. And this week is a big week because you have that MSCI rejig that takes place. So HDFC Bank, that's the stock to track. And the next couple of sessions as well, that's going to be the flag bearer. So keep an eye out on that. The Japanese index, as I mentioned earlier, that index is shut, and that's been the volatile one. So that's good news from a bull's perspective. But we've got a lot of PPI, CPI, as well as retail data that we're expecting from the United States later this week in the next 3 sessions or so. So that's going to be important on the global front as well. A quick word on the ownership in the Indian markets. You're looking at the NSE 500. Well, you look at the FBI number, that's the lowest in the last 12 years. You're looking at the DI number, well, that's making fresh highs. And the retail number as well is more or less steady. So what I want to tell you is that, in terms of total ownership, the domestic money is far more important now. The FIs, probably they're getting to that stage where they can't sell no more because they're down to close around 18.8%. Let's see how that goes because they haven't really been supporting this market. Will they come in higher? That's going to be a crucial trigger as well. But let's focus on year-end now. In Friday's trading session, there was about a short covering that we saw. The Nifty, we did see the open interest was lower, the markets ended higher. And also the futures, the premium out there moved up to around that 30 points odd. In the previous session, it corrected from around 50 to around that 19-point mark. Even on the Nifty Bank, there was about a short covering that did play out, and that out there as well. The open interest was lower by around 5%. What about the FIs and the clients? Well, both of them are net long now on the index futures. The FI position, 22,000 contracts on the long side. So in a matter of a week or so, it's come down from around 1.6 lakh contracts to around 22,000, but they are long on the index. The clients, they were net short with close to 50,000 contracts on the short side. That's U-turned, 80,000 contracts swing out there, and now they're net long with 35,000 contracts. A quick word on the Nifty options data. Well, the 24,400 call, 24,000 put, which perfectly tallies in with what we're going to tell you in terms of the numbers. So the 20 DMA becomes important. That's around 150 points away from where we closed out in Friday's trading session. That becomes the important mark. The bulls will want to get closer to around that mark because the last few sessions we have been going to around this 24,350 to around 24,400. On Friday's close, in fact, it was in this vicinity, which is good news. Now the bulls will want to buy that dip today and get closer to around the 20 DMA, and that level should come up for you in the screen. I think the trend doesn't change unless we go ahead and break the recent low, which is at around the 23,800. So this 23,800 to around 23,900, which has the 50 DMA, become very important. But HDFC Bank holding on to the 20 DMA, that's been the level from where it's bounced. It's currently holding around there. So this is the stock, I think, that you need to track for the next few sessions. Manglam, what else are you tracking?
Absolutely, Nigel. We'll keep an eye out on HDFC Bank. The MSCI flows likely. It's been an outperformer so far. The one data point that I'm watching out for, and that is the gauge of the fear and greed in the market, is the India VIX. On Monday, we saw the biggest intraday move that we saw in the India VIX. which we've seen all the way since 2015, August 2015. And in the interim, we had a bunch of wars, we had a pandemic and all of that and stuff. Nothing scared the market as much on Monday. And as we saw that up move, towards the end of the week, the VIX has actually now come down to around 15. So from 17, 18 thereabouts, it's seen a decline. So all of the fear has now seemed to be digested by the market, and we see that in the global markets as well. The US markets, after seeing some topsy-turvy moves over the first couple of days of the week, now we have mild green triggers coming in for the US markets. And this morning, irrespective of the Nikkei being shut, we have the indices which are trading with gains of almost 1% at least on the Taiwanese index as well as the Korean index. And in that, the GIFT Nifty is actually underperforming. It's down about 30 odd points. So the question then is that will this dip be bought into or not? And if this dip is bought, what is the upside? You guys have been talking about the 20-day moving average as well. So that's the one mark that I'll be watching out for. But apart from that, it is a truncated week and we do have a bunch of triggers this week itself. To start this week off itself, would there be an impact on the Hindenburg news, if any? That is something the street will quantify. The second part, because it's a truncated week, the holiday is on 15th, which is a Thursday. On Wednesday itself, we'll have both the Nifty as well as the Nifty Bank expiry. So that will play out. Then you'll obviously watch out for global markets and macros. You have a lot of data coming out from the US, be it in terms of inflation or retail sales, etc. And then finally, we have the last batch of earnings that the street will be reacting to. Siemens reported over the weekend, post markets on Friday, slightly softish set of numbers, solid set of numbers coming in from Jubilant FoodWorks, etc. And over the next couple of days as well, we'll have a slew of earnings, none market moving, but a lot of them which will keep the broader markets afloat. So those are a bunch of triggers that we'll be watching out for. For now, 30-point downtick. Will the bulls take that? Perhaps yes.
Well, absolutely. And, it's a flattish kind of start. So on an even keel as we begin this Monday session. Jeffrey Dennis is with us, independent emerging markets commentator, is joining us. Jeffrey, great to have you with us here. Thank you very much for your time. Just your thoughts. I mean, the basic question is, has it settled down? And the panic is kind of behind, at least in the very near term, is behind us. But there is also another strain of thought. And you must have seen this, right? When you have this degree of volatility, history suggests that there is another wave. There is a second wave which happens at some point. And usually that is bigger than the first. So how do you address that as well? Your thoughts?
I'm not sure I would rely on another big wave of volatility. We can't always expect history to repeat itself, but clearly this week with the retail sales numbers in the US and both PPI and CPI, there is scope, I think, for there to be some surprises. Looks like CPI for me will be pretty flat at around 3%, which is i.e. in line with what it was in June. My gut feel is that most of this sell-off is over, and I think that it's been an air pocket that the markets have seen. And obviously the unwinding of this carry trade involving the Japanese yen played a big role here. The BOJ doesn't look as if it's going to raise interest rates anymore at the moment. So that will help, I think, to support markets. So I tend to believe that this is another very good buying opportunity, certainly for the long term. Although I think we need to get through this week's data before we can be sure exactly where we go in the short term.
Hi, Jeffrey. Good morning. Good to see you. Well, let's focus on that yen unwind trade. Various guesstimates is what we have been hearing. Do you think majority of that has already played out? And in that sort of a backdrop, what do you expect also, what are you looking at from the Fed? Because just maybe 20 sessions or so ago, we were not factoring in any big cuts. But now the street seems to be pricing in a 100 basis point cut by the end of this fiscal. So comment on both the yen and what the Fed does.
I do think that the bulk of the carry trade unwind has probably happened. I don't have my own independent estimates of that. Of course, I think if we were, as I said before, to get a Japanese yen, a BOJ rate hike soon, another rate hike soon, you might see the yen go up further in the near term because, of course, the yen historically is very, very low. So there's clearly scope for more yen appreciation. But I think given what's happening on the monetary policy front in Japan, I think it's unlikely we'll see a big move at the moment. Now, as the markets calm down and we start to see a nice rally off the bottom, although we're clearly still far off the top of the markets as we were, let's say, 2 to 3 weeks ago, I think we're back in the situation the Fed will move rates in September. There is very little chance, I think, now of an intermeeting cut, which I think a few people thought would be the case. I think it's there's a decent chance it will be a 50 basis point cut in September, but my base call would still be that it's going to be 25, and then possibly another 25 in November, another 25 in December. So I don't think, short of the U.S. economy showing more significantly weak data, raising the risk of recession, I think the glide path that inflation is on, slowly towards 2%, suggests probably the Fed is not going to panic. They're going to move slowly, and they're going to start in September, and most likely they'll start with the 25 basis point cuts.
Right, a 25 basis points cut is what you're expecting, Jeffrey. I just wanted your thoughts on something like whether there is case for a 25 basis points cut even now, because I was hearing a bunch of experts. They were saying that inflation is on a downward trajectory. The economy hasn't weakened as much, barring a few data points here and there. And typically the 3-point plan that any central banker has, one is to tackle it through commentary, second is to tackle it through open market operations, and it's the third one which results in any sort of rate change. Do you think we're done with the first two now and a rate change is imminent, or maybe we can dabble with the first two as well?
I don't think we're through with the first one at all, because Chairman Powell, the last time we heard from them at the Fed meeting in July, earlier this month, I should say, I'm sorry, last month now, that, is an open question whether they would cut rates in September. We're going to know more, I think, is when we hear what Chairman Powell has to say at the Jackson Hole Fed meeting later this month, which is always a very, very important meeting. So I think he's going to tee it up then. And I think that's going to be the point where he's going to make it pretty clear that they're going to reduce interest rates in September. But I don't particularly think they're going to move any faster than that, unless you get a resumption of this intense market volatility. Now, of course, the Fed always says they don't react to the markets and they react to fundamentals. Yeah, except the markets, if they fall a lot further, could affect the fundamentals. So at this point, with the market settling down, I think you've got a 25 basis point cut in September, most likely. And I think the data, for me, points towards slowdown, not a collapse in the economy. The payroll numbers possibly overemphasize the downside. Unemployment is still relatively low. So I'm still in the no recession camp, frankly, although the chance of recession is obviously increased. And I think if we stay in the no recession camp, with inflation gradually moving towards 2%, but it'll take some months still to get there, I think this is a case for gradual rate cuts, not for a panic reaction with a 50 basis point cut, or even bigger than that at this next meeting in September. But we need to watch what Chairman Powell says, because he will tee this up in his Jackson Hole speech later this month.
All right, Jeffrey, we'll leave it there. Thank you very much for your time. It's a pleasure having you with us here on CNBC-TV 18. Good conversation, as always. Jeffrey essentially saying that, according to him, this event of global volatility is behind, and perhaps it's a good buying opportunity from a long-term perspective. Some more opinion. Venugopal Garre of Bernstein put out this note. He says that while we're not in a camp of a large downside to India equities and stay neutral on Nifty, as we see it fully priced, we bucket the bull cycle into three phases. Phase one, he says, is the phase of denial, where a strong macro and earnings outlook drives the re-rating. He adds overvaluation concerns emerge at the end of phase one, and rational decision-making remains intact. Phase two, according to Bernstein, is the acceptance phase, where hefty valuations start to gain acceptance as the new norm. Rational investing still prevails. Phase three, he says, is the invincibility phase, where public market investors start to think like venture funds, that there is limited scrutiny on business models and earnings models. Valuations discussions are limited, and the era of imagination commences. Venugopal says we are at the end of phase two, with some signs of phase three emerging, and hence they remain selective with specific picks across sectors. The era of imagination, I like it. We'll try and have Venu with us on the show later on the program.
All right, that's about the markets. Let's get you some money market views as well. B. Prasanna of ICICI Bank says the dollar and consolidated aggressive front loading of rate cut pricing moderated as recession fears receded on better than expected weekly jobs data in the US. He says that After initial bouts of carry trades unwinding, the low-yielding currencies have given up their gains partially. Also adds that this, along with strong intervention from the RBI and a hawkish MPC outcome, supported the rupee, which recovered from its low and hinged around that 84 per dollar mark, even if near record lows. He says currencies will take cues from the US inflation data this week, expects the RBI to intervene on the rupee from either side, and expect the USD INR to trade in a band of 83.75 to 84.25.
Okay, Prasanna also weighs in on bond markets. He says global yields recovered from recent lows as recession fears decline and expectations of a gradual rate cutting cycle look more probable. Locally, he says the MPC remain ultra cautious in inflation without even a hint of dovishness. However, he adds no specific announcement if OMO sales was a relief for bonds, leading to consolidation. He expects the bond market to trade with a positive bias, owing to continued demand from end investors and FPIs, and expects the 10-year benchmark yield to trade between 7.85 to 7.9%. All right, well, that's lots of opinion. Time for a quick commercial break here, but our list of stocks that we want to get to you is coming up next with our research team. Stay tuned.
Welcome back. You're watching us here on Bazaar Morning Call. The GIFT Nifty indicating a 30-point downtick at the open for our markets, but a lot of individual stocks will be in focus. And for the same, we have our research team standing by with the CNBC-TV18's list of top stocks for the day. First up will be Siemens, reacting to numbers slightly softer than street estimates. Vamakshi joins in.
Well, absolutely. It was a weak set coming in for Siemens. Revenue came in at 5,203 crores. This is an uptick of 7% on a YOY basis, but the street was expecting a much higher number. Therefore, it's a miss of almost 10% as compared to street expectations. EBITDA margin came in at 13.3%. There was an improvement largely being driven by the gross margins, but as compared to the street expectations, the company fell short of nearly 80 basis points. Net profit came in at 577 crores, up 27%, but lower as compared to street expectations. When we look at segment-wise revenue, the energy segment was lagging. It degrew by almost 2%. Smart mobility, smart infra as well as mobility were the two segments that was driving the growth. As far as margins are concerned, energy and smart infra margins did expand, but the mobility margin saw a deep cut of almost 381 basis points. Order inflow, on the other hand, was healthy, up nearly 18%. We also have a note coming in from Kotak. They have a sell call on the stock. They've given a target price of 4,600 per share, and they've gone ahead and cut their PAT estimates by almost 8 to 10%. So overall, a weak set coming in for Siemens.
All right, Vamakshi, thanks a lot for that. The stock that I'm watching out for this morning is Jubilant FoodWorks. They reported their numbers post-market on Friday, and the internals suggested a solid performance. Why do I say that? Because, even though like-for-like growth came in at 3%, the higher end of street expectations of 2 to 3% as well, the delivery channel grew by about 12.1%, and that was one channel which, the company has been backing by removing the delivery fee, etc. as well. And if you look at it in context of all the other QSR performers this time around, Westlife had a 7% decline in same-store sales growth. We had a 7 to 9% decline in Pizza Hut, KFC as well, down 6 to 7%. Burger King was the only one which was up 3.1%. In that, a 3% number is definitely top quartile. If you look at the reported numbers as well, 1440 crores on the top line as against street expectations of 1425 crores. EBITDA as well, largely around the pole of 280 crores, and net profit a little above 51 crores, in line with street expectations. They've added 34 Domino's stores versus expected 40-45 stores, which also means that, the same-store sales growth would improve going forward because the store additions have not been as much. And they've added 8 Popeye stores in the first quarter, reaching that mark of 50 stores as well. So a turnaround for Jubilant FoodWorks continues. I see some green on that stock.
All right, Mangalam, noted. Thanks a lot for that. Well, let's hop across to Ekta. Ekta, tell us about the pharma space. Oro Pharma came out of its numbers. How were they?
Well, largely an inline set of numbers. So the revenue was up around 10.5%. Street was expecting 11% growth. Margins 21.4%. Street was anticipating 21.5%. And the profit at around 918 odd crores was below estimates. But the US sales, that's probably the reason why I'm expecting a mild red, was below estimates. So it came in at around $426 million, which was low on a Q1Q basis, and versus some estimates of around $440 to $450 million. But other segments made up for it. So growth markets was up 49%. ERV segment was up around 14%. Commentary is going to be key. There's a call at 8:30 a.m. So the stock trajectory could just change based on that.
Okay, all right. Thanks a lot for that. Ekta, Mangalam, coming back to your busy weekend, eh? Couple of more stocks you're looking at, Honasa as well as Metro Brands. Tell us more.
A bunch of them, yeah. Honasa, actually, it's a good set of numbers coming in. You know, the street was anticipating that the company go ahead and report at least 2 times industry growth on the top line, and that's exactly what they've done. What's good is revenue growth is 19.3%. It's led by an underlying volume growth of 25%, far exceeds all the other numbers that have come by. But again, you know, it's a company that's been growing fast. Has that seen an impact on their operating performance? Of course it has. Margins are up 200 basis points, EBITDA is up 58%, and the net profit on the back of that is up 63% at around 40 odd crores. What's not good is that, you know, the growth has been led, despite that, the company is not actually reduced ad spends as a percentage of sales. It's still at 36%, comparing with 35%. And they are, you know, reducing their inventory and revamping their distribution. So in the near term, there could be some sort of inventory correction. So that is something I'll be watching out for. Going with green for Honasa. On the other hand, for Metro Brands, remember this time around, there was softness in the overall consumption environment, lower wedding dates, heat wave impacting footfalls. All of that has led to a 1% decline in their sales, about a 3% decline in their EBITDA, and the net profit also declined by about 1.5%. They've opened 17 new stores. It opens in the red. Let's see where it goes from here, because they've maintained their 225 store addition guidance over the next couple of years, and they have a bunch of opportunities in sports and athleisure through tie-ups like Fila, you have New Era, and very soon they will be opening the Foot Locker store. So I'll keep an eye out on this.
Okay, all right, Mangalam. So those are a couple of those names. But let's hop across to Sudarshan, who's here to tell us about Balkrishna Industries. Morning, Sudarshan. Numbers look good, though there are headwinds that could come up in Q2. Tell us more.
Morning, Nigel. So for tire companies, more than Q1 numbers focus on the demand outlook, because the demand has been weakening, and also we have been seeing continued increase in the rubber prices. Now, so first talking about the numbers were higher than estimates, or slightly like almost in line with estimates. Revenue has increased by 26%, EBITDA was up 32%, margin has come at 24.4% against estimate of 24.6%. Volume also was in line, it has grown by 24%. Also, companies looking to increase the capacity at Bhuj plant with an investment of rupees 1300 crore. Now the important part comes, that is the commentary for remaining part of the year. Company says there was softening in demand after a strong Q1. It sees minor sales volume growth for remaining part of FY25. Also, it expects tepid demand environment due to macro challenges, and company will strive for maintaining EBITDA margin of last year that company had seen 24.8%, and it's seeing weak demand at the end user place, and also channel inventories increasing. So numbers were in line to a slight beat, but the commentary for remaining part of the FY25 is weak. That's the reason I'm going with red for Balkrishna Industries.
All right, so thank you very much for that. Aarti Industries is the next one. We're going to focus on reported numbers. Sonal has got details. Sonal, morning.
Good morning, Prashant. It was a good set reported on a YOY and on a quarter-on-quarter basis. The revenues, they grew 31%. We saw an EBITDA growth of 53%. Margins expanded by around 200 basis points, leading to a profit growth of 94%. The sequential recovery and a YOY recovery is something that the street would like, because it has come in after a long time. The conference call is at 4 p.m. today, so we'll get more details on guidance, because remember, the company had earlier indicated that in FY25, with new capex coming up, they will be able to do EBITDA between 1450 to 1700 crore rupees. The stock already up 15% year to date and trades at 27 times FY26 EPS, which is not very expensive but not cheap going by sector averages as well. But that stock should see some green today.
All right, so that's about Aarti Industries. Vivek joins in with his take on what CESE numbers look like. Vivek.
Well, good morning. A very mixed quarter as far as CESE is concerned. Now, remember, very high energy cost is something that has subdued the EBITDA, and also other one-offs also were there in this particular quarter. What's actually aided the bottom line is the fact that the company had much higher regulatory income. Going forward, key to track will be whether the company continues to go ahead and charge customers for the higher energy cost that the company is currently facing. Looking at the numbers, revenues higher by 13%, coming close to the 4,863 crore mark. Now, on the back of cost of energy going up by almost 55%, EBITDA went down 49% on a year-on-year basis at 371 crore. Margins this time quite weak on a year-on-year basis, 7.6% versus 16.8%. Profitability aided by the regulatory income was higher by 5.5%. Now, going forward, the company did say that Kolkata distribution has started recovery of the fuel and power purchase adjustment surcharge, and this is something that will aid the earnings going forward. Going with the red on the back of the muted set this time around.
Okay, all right. Thanks for that, Vivek. Well, going back to Rima. Rima, tell us about MapMy India.
It's a decent quarter, steady quarter, but a slower quarter in terms of revenue growth. So revenue growth has come in at 13.5% on a year-on-year basis. This is lower than the growth rates that we've seen in the prior quarter. And the company has said that in the quarter, there were known ramp downs of certain auto programs, but the ramp up of new programs has begun in Q2. Margin performance is good. Margins are up 20 basis points on a year-on-year basis at 42.1% and a big jump on a quarter-on-quarter basis. Profits are up 11%. The company in the commentary says the levers for growth and profitability are in place. They're on track to achieve their milestone of crossing 1,000 crore revenues by FY 27-28. Back to you.
Okay, well, there's a lot happening, and we keep track of this one as well. Aavas Financiers is going to be the next one, which should be seeing some price action. Vivek is here to tell us why. Vivek, morning.
Well, good morning. Interesting development over here. Change of ownership is what Aavas Financiers will be seeing. CVC Capital Partners has gone ahead and will be acquiring a controlling majority stake in the company. They will be acquiring the entire 26.47% stake from the existing promoters, which is Kedara Capital as well as the Partners Group. Remember, they held 26.47% stake, and this particular stake will be purchased at 1,635 rupees a share. On the back of the majority stake being purchased, the open offer has been triggered, and CVC Capital Partners has announced an open offer to acquire an additional 26% stake in the company. The open offer price is a little higher, coming in close to 1,767 rupees a share, and approximately 7% premium to the last closing of the price. So this particular amount of the additional 26% stake will cause an outflow of close to 3,660 crores, going with the green on the back of the open offer price being at a premium to the last closing.
Okay, all right. Thanks for that, Vivek. And that overhang as well goes out of the way. A deal done at around 2.5 to 3 times price to book. Well, just a quick recap of all the top stocks we discussed. The ones with positive news flow include Jubilant Foodworks, Honasa, Aarti Industries, MapMy India, and Aavas Financiers. We also have Siemens, Oro Pharma, Balkrishna Industries, Metro Brands, and CSE that could react to negative news flow. That's about the equity markets. Let's tell you what's going on in the commodity markets. Manisha Gupta joins us to tell us just that. Morning, Manisha.
Morning, and thank you for that, Nigel. Well, we've started on a positive note for most of the commodities here, barring base metals. That has continued to decline, but the crude oil prices have bounced back from its 8-month lows. We've seen 3.5% of gains in the previous week, and the positive economic data, the U.S. Fed rate expectations, and the Libya-Sharara oil field disruptions are some of the factors which seem to be supporting crude oil prices. If you look at the crude products like heating oil, natural gas, even coal prices are doing quite well. The markets will now for this wait for the U.S. inflation data and the U.S. retail sales data. All of these data come in between Wednesday and Thursday going forward. A quick word on the precious metals, where we also are looking at prices trimming their declines. The global financial markets have stabilized, and we are looking at geopolitical tensions, rate cut expectations. All of that seems to be supporting this sector also.
All right. Manisha, thank you very much for that. So that's commodities in focus. We'll take a quick commercial break here. We are going to come back. Prakash Diwan joins in for some fundamental stock conversation. Lots to discuss, earnings and otherwise. So stay tuned.
Welcome back. Well, a lot of stocks to track, so let's get some analysis going. We have Prakash Diwan who joins us on the show. Hi, Prakash. Good morning and good to see you. Well, let's analyze a couple of numbers. Siemens, the numbers look a little bit tepid. Valuations are not cheap at all, but there's a story ahead. So how would you play it?
Good morning, Nigel. So you're absolutely right. If you put Siemens numbers alongside ABB's, you'll realize that both these companies have had a lovely, run through in terms of the last couple of years, thanks to the power sector reforms. But now it seems like we need to give them time to actually start catching up on the earnings trajectory. The narrative is very strong, no doubt. But, execution is always a challenge in the context that we are. And any slippage in execution, any slowdown, if something spills from one quarter to the other, is bound to kind of make people look askance in terms of whether these premium-rich valuations could be accorded. So I would believe numbers tell you that take a pause, don't kind of jump at it, you will get better opportunities in terms of price levels to enter some of these stocks. So, wherever the long-term story is intact is when you kind of look at these stocks to buy at lower levels. It's very clear. You identify them well. These numbers also tell you one simple thing, that the margin expectation, that we have had has been a bit too high. So as compared to that, the margins have been pretty good. But then, the revenue buildup is in some of the segments is something which can't kind of be, all the time superlative. So I would believe that they will probably do lesser business than they've done in the last 4 quarters going ahead, but at probably superior margins, because that's what companies typically tend to focus on. So if you're okay with that, you could continue buying into it or hold on to it. But I would wait for another couple of quarters to see how the narrative pans out. But yeah, good numbers, good trajectory, everything's in place, but the valuations are too demanding.
All right, valuations demanding a big up move is what we've seen already in the last 12 months or so. Prakash, I wanted your thoughts on Jubilant FoodWorks. Why is that? Because, 3% LFL, one would say that, it's not very impressive. But you look at all the others, Westlife had a 7% decline in SSSG. Pizza Hut, depending on whether you're looking at Sapphire or Devyani, both of them, KFC and Pizza Hut, had about 7 to 9% decline in SSSGs. Here, something seems to be turning around, especially on the delivery front. A 12% jump is what we've seen out here. Do you think the stock and the company is on the verge of a bit of a turnaround?
Good morning. Absolutely. I think on the margin, it's not this quarter. If you look at even the previous quarter, the first indication of some sort of a turnaround in numbers had started happening there. And the fact that the company has had the gumption to go and expand the Popeye stores, it very clearly tells you that they are much more confident about what is happening on the ground. They wouldn't have done those kind of things. They would have probably stalled that, taken some pause. But my sense is that their ability to scale up in most of these verticals is actually very evident. And why the others are struggling, there is fatigue. There is fatigue because in terms of a strategy, it's only Jubilant that has tried reinventing itself about 2 or 3 quarters back. And that's kind of now taking shape or started to show some impact. I'm quite positive on it. From the entire QSR pack, if you look at whether it's Sapphire, RBA, Sapphire, of course, has some salience along with it. But if you look at, rest of brands, Westlife, there is a little bit of a stagnation that you'll probably anticipate. And remember, we are getting into, peak festive season, a lot of holidays, people traveling around, moving out of home. So all of that will also happen. The in-store dining numbers, if you actually want to slice those a bit further, I think it's a strategic move to keep that low. They're not pushing much for it because of the kind of capex that it would need to go along. But I think the delivery is where they are focusing on, and they've seen results. So quite happy with the numbers.
And this next one also should be should catch your attention, Prakash. I'm talking about Amara Raja, the company. It's unveiled its gigafactory just outside Hyderabad, set up at an investment cost of 9,500 crore rupees. The company will build battery packs and lithium-ion cells for electric two-wheeler and three-wheelers. My colleague Jude traveled to the gigafactory and had the opportunity to speak with the management. We're going to play out a soundbite, Prakash, coming to you for a reaction post that.
The facility we're in today is our pack facility that we've inaugurated the phase 1 of. This facility today houses about 1.5 gigawatt hour of pack manufacturing. And today we have our two-wheeler and three-wheeler lines up and running. And eventually this facility will house about 5 gigawatt hour of pack manufacturing. This facility, I think, is largely catered to light electric mobility, which we're very bullish on. We think that the trends of electrification in two-wheeler and three-wheeler, they may kind of, they may slow down at times, but mostly we don't believe that these segments are going to go backwards. I think the electrification route is clear. It's unidirectional. We are seeing a lot more, movement on the passenger vehicle side, little less on the penetration numbers, but definitely we are quite bullish that India will adopt the EV story, especially because I think for our cost points, we're a very value vehicle minded country, and some of the brands that have come in and been able to crack, that price point and the kind of the features, it's definitely going to go up, and we feel that we're in a good position to capture that. Aethers, they have a huge amount of data and user experience that they have from all the bikes and the kilometers they've traveled, the number of packs and cells they have already installed in the market. So a lot of that is going to be made available to us to exactly spec the type of cell that they feel is going to be most relevant to succeed in the Indian road conditions. And by the time we start manufacturing our cells here, I think we'll have a very good design, and we'll be able to, give that to Ather to start and many other two-wheeler manufacturers. With Piaggio, we are working on, actually it's a pretty expansive relationship we have with them. We started about a couple of years ago. We started with packs and chargers, and now we're into, a second or third generation of pack. Next generation of chargers just coming off our lines in a town called Diguvamagam in Andhra Pradesh. And what we've agreed today also is, in addition to this firm fixed business over the next few years, also localizing cells inside these packs is now on the anvil.
Well, that's a pretty interesting conversation, and we'll play out more of this, through the course of the day with Amar Raja. Prakash is with us. Prakash, you've been listening in, I trust. There is, of course, Amar Raja, what's happened with Exide. Amar has also done well, but not as well as Exide.
Yeah.
So if you have any thoughts on Amara specifically, but also, since we're talking about battery cells, right? I want to talk about Ola. The listing happened and stock ended limit up 20% on Friday. So I wanted your thoughts on Ola as well. You want to start with Ola or Amara, your choice, but just a quick word.
Yeah, so let me get the Ola thing out of the way, because that was quite, exciting to see. To be honest, I was surprised. The response to the IPO wasn't as great. Market indications were that it would probably just list at a very small premium to the offer price. But it looks like, there is a demand for a theme that's very catchy. And given their current leadership status, people believe that they'll be the proxy to the EV two-wheeler space. And there's a lot of expectations built around that. But in my view, that's overdone. I would still not. In fact, if I had some allotment, I would get out of it at those levels. On Amara Raja, I'm very sure, Prashant, we understand that this is a company that took some time, given the nature of the capital restructuring that happened a few years back. Ownership change, new management kind of started driving things. And the catch-up that they're doing is very smart. The capex that they've done, and this is a reflection of that. I'm glad you could share with the audience, the live visuals of this place. It's a very state-of-the-art kind of a facility they've set up. And they've already got assured clients for this. So, typically what happens is it takes time for ROEs to build up when you have a huge capex. And that's why Amar Raja, the stock probably didn't do as well as Exide in percentile terms. But I think at 22, 23 times FY26, it's definitely something which is giving you a very good risk reward. I mean, on a trailing basis, it's available at 27, 28, if I'm not mistaken. But 27,000 crores for a company that's built a capex, built a facility which could deliver revenues over the next 3 years as much as a market cap, I think it's a fabulous opportunity. But you have to trust that execution skills of the management. And if you are fine with that, I think the company is available at very good levels.
Right, Prakash, we request you to stay on. We'll take a short break at this point. On the other side, we'll discuss the big development over the weekend, all the news coming in with regards to Hindenburg saga. In fact, we also will have Madhu Kela, the founder of MK Ventures, joining in to put focus on these allegations that Hindenburg has made against the SEBI chairperson. Stay tuned.
Okay, welcome back. There is the Aurobindo Pharma con call also sort of going on, and sort of interesting details. Lots of interest around Aurobindo. Some large funds have bought in. The Divi's numbers were not great. The Divi's con call, though, laid out a very positive outlook for the US generic pharma industry. So I think there'll be keen interest here in Aurobindo as well. But let's sort of rewind and look back at, of course, what dominated news wires and, of course, social media, etc. over the weekend, which is the Hindenburg research report, which has actually put out allegations on SEBI chairperson on counts of conflict of interest with regards to Adani Group, and questioned her credibility in investigating Hindenburg's allegations against the Adani Group. My colleague Nisha has sort of been looking at this entire matter, and she's here with a comprehensive report of what has transpired. Nisha, over to you.
Thanks for that. Yes, Hindenburg Research's recent report has cited conflict of interest with Adani Group and therefore questioned the credibility of SEBI chairperson Madhavi Puri Butch. And on the other hand, Madhavi Puri Butch has refuted all by pointing to SEBI's disclosure as well as recusal norms being diligently followed. This is the sum and substance of this big story that we are looking at. Now let's get into the specifics. There are 4 counts of allegations. 1, investments in offshore funds allegedly used by Adani to siphon off funds, and there 2 funds have been mentioned by Hindenburg Research. One is IPE Plus Fund and Global Dynamic Opportunities Fund, where they've also mentioned listed company 361 as the one helping with and facilitating those fund mechanisms. Now, on the other hand, conflict of interest on a Singapore-based entity, Agora Partners, where, according to the report, Madhavi Puri Butch still holds a stake. And on the other hand, Agora Advisory India, which is an Indian entity, and there again, they claim that it's an active current consulting firm which is generating revenues and is owned by Madhavi Puri Butch. And fourth, they have also mentioned the linkage of her husband, Dhaval Butch, as the advisor of Blackstone, which they say has acted in giving benefits to Blackstone's REITs operations in the country, and therefore a smooth and profitable exit. Now, looking at the clarifications coming in from SEBI chairperson, and she has point by point refuted all the claims, also citing disclosures and recusal norms of SEBI, and that have been diligently followed. She said that the investment in funds were made in private capacity when she was a private citizen. She has also stated that there was no linkage or investment in Adani Group by way of her investments in these funds. And with regards to Blackstone, it has been on the recusal list maintained with SEBI because of the connection, and the 2 consulting companies set up by Madhavi were immediately dormant when she was appointed at SEBI. And she also goes on to say that all this has been explicitly part of disclosure norms of SEBI. On the other hand, SEBI has also put in its might behind the chairperson, backed her by saying that they have followed a due process in investigating the claims that Hindenburg Research had put out against Adani, and they have investigated it. On the other hand, they have said that all the matters involving potential conflict of interest have been disclosed by SEBI chairperson, and she has herself recused herself from potential conflict of interest. She has now SEBI has also cautioned ahead of the market opening today, and this must be noted, that they have said that investors must exercise calmness as well before, and also due diligence before reacting to this research report. And they also say that Hindenburg Research may have short positions in the security covers in the report. Here I would like to mention Adani Group as well as 361 are the 2 entities on the listed front that is being mentioned in the report. Hindenburg's counter questions after these rebuttals had been received from SEBI as well as SEBI chairperson, they have said that while the statement states that prominent clients in Indian industry have engaged in the consulting firm, do these include clients SEBI is tasked with regulating? Again, citing conflict of interest. And they have also said that SEBI was tasked with investigating investment funds relating to the Adani matter, which would include funds where Ms. Butch was personally invested in, and they have reiterated their claim of obviously a massive conflict of interest, quoting them. And an important question being raised here by Hindenburg Research is that will the SEBI chairperson commit to a full, transparent and public investigation into these funds? So these are some serious allegations countered by SEBI chairperson as well as SEBI as well. And on the other hand, 361 has clarified that IPE fund had investments from Madhavi Puri Butch, and during their lifetime in which they did not invest in Adani Group of shares, they have also categorically mentioned to CNBC TV18, the second fund mentioned they had no linkage with that fund. And AMFI has also come forth with a statement that recent criticism of SEBI chairperson seen as an attempt to undermine India's market progress. So this is the whole account of the conflict which has emerged, and more to be seen going forward.
All right, Nisha, thank you very much for that. So that's basically, essentially the entire thing playing out and how perhaps we may go from here. We'll take a quick commercial break here. Madhu Khela, founder of MK Ventures, will join in on the program. We'll talk about some of these allegations and, is there any market implication at all? So that conversation comes up next. Stay tuned. Okay, welcome back. There's 4 minutes to go for the pre-open session. The GIFT Nifty is indicating an absolutely flat start. Let's actually talk about the big story over the weekend, of course, which essentially was that Hindenburg report, which Nisha outlined for us so well just before that break. Madhu Khela is with us. He's founder at MK Ventures. He's with us here in our studios. Madhu, great to have you with us here.
Thank you
very much for your time.
Thank you so much.
How do you
pleasure coming here.
I mean, always great to see you on a Monday morning. How do you view this entire sort of report? I mean, this back and forth which has happened. What are the implications? Because social media, there's all kinds of stuff out there floating around. I heard some people saying, well, market impact could be this, that, and I was wondering, well, why? What is the reason? Your thoughts?
Prashant, I have, fortunately, it came on a weekend, so I've had a chance to read through it fully. And I read through all the responses also. See, frankly, first as a market person, I am unable to add all of this together as to what is the real allegation, right? If you are a private individual and if you have invested into some fund and on the recommendation of a close friend and the fund has got redeemed as soon as the friend left the job, right? So what is wrong in that? All the money which is being made is legally made. There is a 30-year career behind it, and you are living out of India. So what I can't. The second, the allegation is that the husband is working in Blackstone. So what do you expect to do? But is he not supposed to utilize his expertise and the work which he has done, right? So I think, Prashant, honestly, this looks like some real big conspiracy to me. And this is not an attack on an individual group or on an individual. It looks more like an attack on India. It looks like an attack. You sensationalize such a thing, something big is coming. What is so big about it? This is just... And after what they have clarified, see, they have had a clarification from IFL fund, you have a clarification from the chairperson, you have a clarification from Blackstone. And I am sure those clarifications are more than clear. That
and what I like about the thing was that the responses came very fast, right?
Exactly,
and
because there's nothing to hide. If you have something to hide, then you will try to take time, this, that, because there's nothing. It looks like there's nothing to hide. So I just don't feel that there will be any impact whatsoever.
And the other good thing which we've seen is that the sort of industry has come together, right?
And Prashant, the reason why I came today in the studio, honestly, obviously, I'm one call away always for all you guys. I feel this is the time when we all must stand behind the country. We must all stand behind the person who has immensely contributed to the development of capital market. And I have seen it personally, right? We in our golden days of mutual fund, Prashant, the distribution commission used to be as high as 6%. And we have come such a long way in terms of so many regulations, ease of doing business, and which has all been aimed at protecting the interest of the small investor. And to malign image of an individual who, to my opinion, again, it's personal opinion, I think she must have contributed maximum till date from a regulatory standpoint of view in the development of our markets as an individual.
So for a bunch of people who are looking at Twitter before they look at the ticker, and you said that, this is obviously, it seems like a bit of a hit job against the country. what would your message to investors be, and all those who are looking at the Indian stock markets, who are looking at this noise on social media and are a little worried about their portfolio, or what steps should be they be taking?
I
your
would
message.
say that, first of all, you see, I think markets have been extremely resilient.
Yes.
And to the extent that it has even surprised an optimist like me.
Yeah.
Like we have seen elections, we have seen budget, we have seen long-term, short-term capital gains, we have seen Japanese yen carry trade market. So there is clear interest, and equities, it seems, have come a long way, and it has become a real asset class. Pehle kya tha? Equities was a means to make some speculative gain, that you get a tip and you come in and come out. That this is really getting as an established asset class. If this money was only going into small cap individual stocks, then I would be worried. But the fact that 23,000 crore rupees is coming into mutual fund as an SIP, that gives me a lot of confidence. So I think from a investor perspective, because of this event, and I'm very vocal, very clear, I'm not mincing word, I think because of this event, I don't think investors need to worry at all. I don't think this is any event which will destabilize India or destabilize the market, or there is any risk to market because of this event. Well, tomorrow morning something else may happen which may make the market go up and down. But I would not be nervous at all because of this event.
All right. Madhu, Hindenburg, when they came out with the earlier report, they made a mark on the Indian markets, right? Everyone took note of it. Do you think this recent report actually has damaged the reputation, and now people will say, you're not talking anything of practical or anything of substance? They have, I think, from here on, do you think the markets continue to ignore what they have to say?
A brilliant point, because they, before releasing this report, they should have thought about their own credibility. Right? And I don't think that people took the first report, they took a note of it, whatever. And obviously nothing has come out, and if you see the group, they have come out with the flying colors. Even post that report, so much so that they did a $1 billion QIP just few days back, and absolute who and who, whether it is institutional, domestic investor, global investor, high net worth individual, everyone has invested into the group QIP, including me, I must say. So I am just saying that I don't think this will do any damage. Again, I reiterate, to whether the group companies or to market by and large.
Madhu, let's talk about. Let's keep this aside now, right?
Yeah, absolutely.
I think
only this much discussion is required.
Because the market also will do that, I think,
exactly.
as you say. How is the market itself looking? Last week was a bit, for 2 days, it was a bit, looked like a bit scary, right? I mean, implied walls, etc. Is that behind us now?
Prashant, no. I think let's take a practical view. We have had a tremendous gain in the market in the last 3-4 years. Even at an index level, the CAGR is more than 30%, right? Individual, lot of companies have gone up 1, 3, 5, 10, 20 times from the COVID low. So first thing is, you cannot extrapolate what has happened in the last 3 years, right?
Correct.
When you are even investing for a long term, your return expectation has to be very, very moderate going forward, because over a longer period of time, there is a certain basis point more than fixed income is what you can make in equity, right? Because if this kind of money is being made every day, then why will anyone do business? Everyone will be only in the stock market, right?
That's what a lot of people also do.
So if the company is making 18% ROE and the stock market is going to deliver 35% return, then why will any businessman do business? They will also be in the stock market.
Absolutely.
So that return expectation has to be moderate. Second thing, that there is clearly discomfort to even an optimist like me in certain pockets, right? So if you are investing in mutual fund, you do your homework, invest in good mutual funds with a track record, no issues at all. But if you are investing in individual companies, you should definitely be watchful of what you are paying, what you are assuming, and then what is it that the company will deliver, then you make money. So that is about it. Third, is the India story from a medium to long term perspective, is it still there? The answer is a clear yes. I think the India story is still there. There is, if I take a 10-year average of Nifty valuation, Nifty is at certain premium to the 10-year average, but that is for the factors which are very clearly visible. You have a stable inflation, you have a stable interest rate, you have a stable 10-year bond yield, you have all the macroeconomic factors have not looked as good as they are looking today. So there is certain valuation premium which is justified. So Nifty by and large, I can't see a euphoria in Nifty valuation.
Got it. So no taking away from the long-term structural story that India is right now. There are pockets of discomfort according to you. Then let's wrap it up with what are your pockets of discomfort and where is it that you see immediate opportunity in terms of valuation?
So Mangalam, the pockets of discomforts are where there is only story and where the valuations are high. And I don't say that pockets of discomfort may be there in capital goods also. Right. It may be there in defense companies also. It may be there in some railway companies also. So it is there almost in every sector where you can pinpoint that I'm not comfortable with the valuation. However, as I said, large cap companies still offer reasonable risk-adjusted return. I like the pharma sector. We have spoken about it even last time. The pharma sector has actually done. Select companies in IT look very compelling. Select companies in FMCG basket where I think the consumption will come back. The stock prices have already started moving up. We spoke about the liquor sector, which looks like a structural long-term story. So I think there is enough. And someone like me, I am always open to an idea. But I am also not hesitating in this kind of market to sell companies. Wherever I don't have comfort and I don't get overly worked up with some amount of cash if I have created, I'm not getting overly worked up. I am very happy with the return which I have made, and I am very happy to underperform a little bit if this euphoria in certain pockets continue.
That's well put, Madhu. Great conversation. Thank you very much for dropping by.
Thank you so much, Prashant. Just one disclosure. We spoke about individual companies, sectors. People need to do their own homework before.
I think you made that absolutely amply clear that they must, right? I mean, if you put money into individual stocks, they must be doubly sort of careful because prices generally have done very well. Thank you very much.
Thank you so much. Thank you so much.
And great speaking with you. We'll actually look at the pre-open session and how things are. I mean, I think the pre-open session should be settling down. The sensex is, I think, down about 400, and the Nifty is coming up with a slight downtick there as well. Mitesh and Sudarshan are with us with what they'd want you to do in terms of trades. Gentlemen, good morning. Good to have both of you here. Mitesh, you go first. How are things looking?
Morning, Prashant. So I think, we had some decline and then bounce back the last few days. I think 24,000 is now emerging as a good pivot. But my worry still is the strength or lack of strength to capture the upside level. So 24,400 is the first level to watch out for. But the key reversal would happen if we can capture 24,630, 680 zone. I think once that is done, then I think, we can assume that the market is safe and we'll possibly start making newer highs. But for the time being, that remains a very important ceiling. So trading is more stock specific, but at higher levels, I would be wanting to accumulate some index puts.
Okay, all right. Sudarshan, what about you?
Well, my view is that we are in a short-term uptrend again. The trade is to buy on any dip, and hopefully we'll get a dip today. It's the same advice I gave on Thursday, and anyone who bought on Thursday's dip will be very happy. So assume that this market is not bearish. If it is not bearish, then we want to be buyers. Just keep a 150-point stop loss and be long on any small correction.
Clear. Sudarshan, tell us your stock picks though.
Sure. Coromandel International is a buy with a stop under 1570. Eicher Motors is a buy with a stop under 4540. My only intraday short is HDFC Life, which is an intraday short with a stop above 720. And finally, HUL is a buying opportunity. It's a positional trade. It's not an intraday trade. The stop under 2660.
Mitesh, your stocks?
Yeah. Morning, Mangalam. I have more of buy calls today. PVR is a buy with a stop below 1480 for targets of 1550. Sun TV is a buy with a stop at 902 for targets of 950. And Eicher Motors, I think with that positive numbers and the news flow, the stock had a gap up. So that's a buy with a stop at 4790 for targets of 4930. One sell call, that's DLF with a stop at 840 for targets of 810.
Okay, all right. Thanks a lot, gentlemen, for joining in and filling us in with those views. Well, let's get to our next company, Stovecraft. Well, the numbers look quite good, given the kind of environment and given what some of the peer group had reported as well. A 5 to 6% growth on the top line with margin expansion. To understand more about the past quarter and the way ahead, we're joined by Mr. Rajinder Gandhi, the MD of Stovecraft, who joins us. Hi, Mr. Gandhi. Good morning. Thanks a lot for joining in. Apologies for making you wait for a little bit. Tell us about your guidance from here on. The start has been okay. The first quarter was supposed to be soft, but you've still done mid-single digits. For the year, can you do those high-teen growth numbers that you were talking about earlier? Point number one. And margins have improved, even though operating leverage really hasn't played out. Do you stick to that guidance of around 11% EBITDA margins for the year and gross margins of more than 38%?
Yeah, thank you. Good morning. The overall business for us is shaping well as planned, and our the investment in the manufacturing of appliances has started playing, and more of these products being made within the factories of Stovecraft have started contributing to the gross margins. We are seeing growth in the gross margin, and we believe we'll continue to grow and at least remain at the current level. And on the business side, the second and third quarter are the main quarters for us. This contribute majority of the revenue for the year. With the onset of Onam and the festival seasons ahead of us, with the events on the e-commerce platform all ahead of us, we are seeing good traction in the market. We believe that we'll continue to grow.
Mr. Gandhi? Mr. Gandhi, we wanted a couple of numbers. So growth of what? Growth, revenue growth. Give us three numbers. Revenue growth, EBITDA margins, and gross margins for the year. Please go ahead.
We are at about 38% on gross margin. We'll continue to be positive on this year. And at EBITDA, we are very confident of delivering 11% EBITDA this year. And on the growth, we believe that we'll be closer to a high double-digit growth.
Can you define high double digit? What is it? Is it mid-teens? Is it early 11, 12% odd, or is it high teens? So what do you mean high double digit?
High teens. We are confident of high teens.
Well, you're confident of high teens. That puts the pressure on the next three quarters as well. If you could give us a sense of, break this growth down across all your segments. What would be the volume growth this year and the revenue growth in your cooker segment, your induction business, your non-stick cookware business? And because you said you started to, manufacture appliances and scale that business as well. So across all your segments, if you could break that growth, overall, it'll be high teen sort of growth. But across segments, what is the growth likely to be this year?
The largest growth we are witnessing and we believe will grow continuously is on the appliances business, followed by, of course, the pressure cooker, and then followed by the cooktop business. Cooktop for us is both induction and LPG cooktops. The largest growth we are confident with, and what we are witnessing is going to be from our appliances business.
All right, two quick points before we let you go, sir. One is on your store addition. If you could give us a sense of what kind of store addition are you gunning for in the next half of this year? And secondly, the cost savings that were likely to come in from the solar plant, have they started? If not, then how much is it likely to save on your costs?
So today, the installed solar and wind, the self-generated power, we are able to utilize 50. The total requirement for power is now 50% within the company. So that is definitely helping us. On the store front, we continue to open between 25 and 30 stores every quarter. We are on that same run rate. And so with the next 3 quarters there, between 70 to 75 stores is what we will be opening. We'll be adding to the existing stores.
All right. Thanks a lot, Mr. Gandhi, for stopping by and giving us, the outlook for the remainder of the year. Short but sweet conversation. Looking forward to having a chat with you as the year progresses. By the way, on the index itself, some of these Adani Group stocks are under pressure. And just one of them I want to highlight. We have the Adani Energy stock. You have a big difference between the BSE and the NSE. So most of the Adani Group stocks, whether it's Ambuja Cements, ACC, all the Adani Group stocks. But just on this one, Adani Energy, there's a big difference if you look at it in, both the NSE as well as the BSE. So keep an eye out on that.
Right. One of the top volume losers on in the pre-open right now is Coffee Day. Well bid on the downside, down 17%. Remember, over the weekend, we did get the notice that the company has been included into NCLT for default of payment. So that stock's down almost 17%.
All right, the first rates coming up on your screens. We'll have the Nifty, the sensex, Nifty Bank, and of course we'll then go on to individual names and stocks, etc. So what do we have? I think we have a bit of a downtick. Nifty starting, I think, about 0.2% lower. So 24,300 is where the Nifty is at. And I think you've got the Bank Nifty, which is starting about 1/3% lower. So 0.3%, that's about 80 points worth of a cut on the Nifty. Bank Nifty, 200-point cut, 50,271. And individual sector stocks, etc. Market breadth is negative, almost about 2:1. Not quite fully 2:1, but right out of the gates, more down than up. That's essentially the picture. Small cap index is down 0.6, and I think you've got the mid cap index, which is also under some pressure. Nifty is down about 90 points, 24,286 at this stage. So this is the market open, but it's all about stocks. So let's get straight to it.
Yes, so that's right. Pull up Voltas. The last few days the stock was a little bit nervous. Those numbers look good. The margins have come in at the highest levels you've seen all the way since March 2022, since that quarter. That stock has burst up close to around 5%. Went tepid into the numbers. I think that's one of the reasons. Amara Raja, well, we have positive news flow that the stock is up close to around 2.5%. Jubilant Food, Mangalam told us those numbers are good, so that stock is flying away. Balkrishna Industries, Sudarshan had highlighted this fact that the numbers are more or less in line or mildly better. The problem is going ahead, things are looking very jittery. So that's why that stock's lost close to around 9%. Sun TV as well down close to around 5.5%, has had a good run. But now, in fact, that's come in for some big profit taking. So, that one comes up for you on the screen. And Ola Electric, well, continues its electrifying ways. Stock is up close to 7.5%, following in that big gain that we saw in Friday's trading session, the listing gains. And also Coffee Day, that the insolvency has taken shape out there. And because of that, the stock is down. It's getting smacked as we speak. You have Imfa, that's the other one that got the 221 crores that were pending. So maybe that one as well is reacting to that piece of news. So all these stocks up and about in today's trading session.
A bunch of other stocks also in focus. If you look at the market breadth, you'll have nearly two stocks declining for every one stock which is advancing. But the ones which are advancing, we have a few of them as well. Inox Wind reported a good set of numbers, stock up around 6%. Good numbers coming in from Shipping Corp as well. That stock's up around 5.5%. Some softness in Metro Brands. The stock opened red, but thereafter the street is looking at triggers ahead, and as a result of which it's moved off lows, currently in mild green. Though we are seeing incremental pressure on names like Sun TV, which is now down about 7%. Astral's the other one, and Bharat Forge, after a decent move that we saw on Friday, has seen a bit of profit booking. Trent, an 11% up move is what we saw on Friday, and this morning it follows up with another 2%, and it's only increasing with volumes piling up out there. And Jubilant Foodworks too, which opened about 1.5% in the green, has now extended its gains to about 3% street, eyeing a turnaround out there.
Well, a few other names, right? Ola Electric will come up on your screen. Ola Electric is the biggest volume-led gainer on the NSE. It's up 8%, and we were talking about this one in the morning with Prakash. So that is coming up with sort of large volume-led gains right now. So that is Ola for you. Nigel mentioned Voltas. That's a big one, 6% pop. Inox Wind is up about 5.75%, humongous volumes. Shipping Corporation, I think numbers, 4.5 higher, 270. Mangalam was talking about Jubilant Food. I think there is an upgrade from Jefferies as well, 617 on Jubilant Food. Aavas Finances, actually there are two microfinance companies. Aavas Financiers is up 7%. There is a deal brewing there. And the other one, of course, is Credit Access, where there are reports this morning which suggest that, the foreign owner is actually looking to get out. So that's the stock's down about 1%. Credit Access, of course, in terms of the MFI space, is rated as, is seen as the highest quality lender in that in the microfinance area. Safari is up 4.5%. That's a luggage maker, 2410. Big volumes at this point. For this time in the day, actually. Coromandel is up about 2%. Graphite is up about 3%. Graphite India, 536. PNC Infra is coming up with a 7% gain, 480. There's more stuff. Ola Electric is up 12% now. So keep an eye on. Actually, we should put up the Ola Electric stock. There's a lot of interest, huge volumes as well, right at the bottom of the screen. It's the largest volume-led gainer. And of course, I think as Nigel mentioned, a lot of the Adani Group stocks are under pressure. Enterprises, Ports, Power, Green, they're all down between 3 and 5, 6%. Adani Wilmar, Adani Total Gas, down 4-5% as well. So this is broadly how we are starting up.
Just one word on Voltas, Prashant. The reason that the stock is reacting so much on the upside is the last few days, the stock actually had corrected close to around 6%. It actually it underperformed the market going into these numbers. And by the look of it, the sense is that they could have gained some market share in the last quarter, on a quarter-to-quarter basis as well, roughly 200-250 basis points. I'm reading a sales note out there. So commentary on pricing will be important, sustenance of these kind of margins as well as inventory situation. That seems to be the stock of the morning after those numbers.
Absolutely, and very large, 2 million shares also on the NSE. So this is looking pretty solid out there. Well, let's bring in Rajiv Batra. He's, of course, with Joe. Okay, I think Rajiv will be with us in just a bit. Maybe just a couple of more names before we take it forward. Bharat Dynamics, BDL, is down 8%. That's the defense company, a PSU defense company, 1318 on Bharat Dynamics. And of course, it's come off quite sharply from the highs. I mean, the high in the month of July, actually, this is the all-time high as well, as about 1720. From 1720 to 1318. In, about 15 trading sessions, not even 15 trading sessions. So that is a very sharp knock that we are seeing here. Lemon Tree has not been able to recover. It's basically a waterfall decline from 150 levels to 116. The first quarter numbers, of course, were a bit of a miss. But, the decline started much before that. The all-time high on Lemon Tree was about 160 rupees. So that's lost quite a bit. And there is IIFL this morning, which is also down about 2.75%. Stocks at about 411, 412 or so. So this is some of what is going on across on the market front. Rajiv Batra is with us. He's of course, with JP Morgan. Rajiv, great to have you with us here. Thank you very much for your time. Appreciate it. Prashant this side. I'm looking at what your note says, and I'm sort of just read out this portion of for our viewers, because this is the operative part. What you're saying is, we worry that such rapid market declines, and you're referring, of course, to what we saw in the Japanese market and, all of the volatility last week. You say, and I quote, we worry that such rapid market declines often lead to unexpected ruptures in the market, from spillovers and cross-asset volatility, dispersion, and private markets to at least margin calls. And any bounds here may not sustain far until we arrive at a new market structure equilibrium. Is that the operative part, Rajiv? Is that kind of sort of in one line the view that you're sort of telling your clients when you're speaking with them?
Exactly. That's what we have been expecting for the second half. So when we wrote the outlook note start of the year, we said to our investor that first half, you will be able to make a good set of a return. Market may operate in a Goldilocks period. And hence, we have seen Asia ex-Japan index operated in the base case and the bull case territory for us. But we knew as we head into the second half, if the positionings are overcrowded and going into one of the biggest event of the year, US election, there could be some round of uncertainty, even in terms of if monetary policy regime is also shifting from tightening to easing. That's what we exactly saw over the last 1 month, where middle of July, due to the tech earnings season weakness in the US, we saw the first bout of the volatility. And now, last week, the second bout of volatility hit due to the carry trade unwinding and the rising US recession risk. And we believe this bout of volatility may need to continue because of either the geopolitical uncertainty, the activity data which is weakening in the US, and maybe even because of some exacerbated or overcrowded positioning in the equity markets too.
So how do you suggest one play this extended period of volatility up until at least the events get out of the way, Rajiv? What are your sector calls, and what are you suggesting investors do to protect themselves from such sort of volatility?
So the prudent measures would be, rather than taking the clear country or a sector call, people should take call within the sectors and more on the factors or the style basis. So the styles or factors which have not done well so far this year, as an example, low walls, quality, or even defensiveness, that's what should be the key part of your portfolio, because in the next month or two, when the volatility swings will keep on happening, the low wall or quality exposures, or even a marginal sustainable growth exposure will help you safeguard your portfolio and prep you up for a possible year-end rally also. But till then, capital protection is utmost important.
All right. Hi, Rajiv. Good morning and good to see you. The big story here for most Indian investors is we are cheering the decoupling. The globe will fall, but if it falls, we'll fall less. And if it goes up, we'll go up more. That's what we believe at least. But at current valuations, what's your view on the Indian markets? A lot of challenges have come about. We didn't get an absolute majority of the ruling government. We got a tweaking in capital gains, but still the market's just 2% away from fresh all-time highs. Your comment on this?
No, so definitely, if you look at the trade over the last month or so, when the global volatility is happening, domestics are faring far bit better. So be it India, be it Southeast Asia, ASEAN market, or even if China, the more you have a domestic exposure, the better off you are. And this is the reason why when markets are declining, these domestic exposures are outperforming. Even based on the feedback from investors whom I'm been talking and traveling and meeting last 5 weeks, have been very clear that they need to increase their exposure substantially towards the domestic haven, that is more South Asia part of the world compared to the North Asia, because of the gyration they are expected to see in the economic data prints in the North Asia side. Coming back to the India, yes, definitely valuations are expensive. And after a bout of inflows, which we have seen post-election result, there is a merit that market could take a breather before again start inching up higher. So tailwinds, positive tailwinds which were there in place like earnings, budget, or even continuity of policy, that tailwinds are now coming to an end and headwinds are approaching. So seasonally, if we see September 8 out of the 10 years is a weaker month for India. Besides that, earnings, if you will look this quarter, have been lackluster on sideline, in line with what everyone expected. And then most obviously, state elections are approaching, which can make people think or have a deja vu of the last year, where going into the state election, markets were on the sideline. So for India, relative terms, we could be still an outperformer, keep on doing well. But absolute term, we will be in a range-bound state.
Speaking about range-bound, there is no dip in Siemens, which is not bought. In fact, this stock opened mildly in the red. Vamakshi did tell us that there was weakness in their mobility business margins, and that dip has been swiftly bought into. The stocks recovered about 3.5–4% from the lows, stock back above that 7,000 mark, and has moved higher. It's already seen a big move, almost 75% from the start of this year. Not particularly comfortable when it comes to valuations as well, but maybe the street is eyeing some more in Siemens going on from here on, and that explains why the dip on that stock has been bought into.
No, absolutely, and there's a fair bit of interest in some of these names that we have been talking about, and that continues. Sun TV is down. Sun TV is down 8%.
Yeah.
So stocks at about what, 842? That's a large cut that we're talking about. It closed at about 916, 917, at about 842 at this point in time. So it's basically been pushing lower from the word go, although it's just still about 10 minutes or so as far as market open is concerned.
The problems are on the margins. The margins, 500 basis points contraction on a year-on-year as well as on a sequential basis. Top line was okay, but I guess that's one of the reasons. It's not as cheap as it was. I think 2.5 months ago, it was at around 650 rupees odd. So at that point of time, the core business, I think you were getting it at around 4 times EV on EBITDA. X of the cash, X of the IPL franchise, if you put a value to that. So now it's not as cheap. So I think the room for, in terms of that valuation comfort went out. I guess that's why the stock is getting pulled back.
Room for disappointment is zero.
Very, very minimal.
So, I mean...
But some of these Adani Group stocks actually have come off the low point of the day. Adani, some of these, Adani Total Gas as well, it's come off a little bit from the low point of the day. I think Adani Enterprises as well. So, yeah, that's the frontline name. Let's pull up Adani Ports as well. So, some bit of recovery from the day's low. Adani Energy Solutions, we had highlighted that there was a big difference, between both the rates. So recovery on one of those groups that are in focus today.
I think, that's absolutely right. Astral is another one I want to highlight. Again, one of these names, again, first quarter numbers were nothing great. We spoke with the management on Friday morning. From 2,500 stocks down to 1,950 or so very quickly. Last 10 or 15 trading sessions is more like it. So there is, price damage occurring on a wide wide swath of stocks. Midhani, which is Mishra Dhatu, I think there was massive compression in margins here. So high was 540, 550, stocks at about 420 now. Although today, from the day's lowest point, is actually trying to come back up a little bit. Zydus Life is another one, has had a one-way move higher. but it's kind of sort of, I think, faltering a little bit. In today's trading session, for the year, it's up 80%, Zyrus Life.
I think even Stovecraft, we had the management.
Yeah.
When you had TTK Prestige, it didn't grow, and Butterfly Gandhimati actually gave a degrowth.
Yeah.
They grew a little bit, and they're promising better times ahead. They've disappointed in the past, but for the time being, Stovecraft is up close to around 6%. So the street will eye delivery, because actually the stock is still, I think, not made the high that it made when it post-listing. So it's still a distance away from there.
Absolutely. It's been one of those sort of underperformers in a market where there's not very many underperformers, the outperformers. Rajiv, from a flow perspective, right? What does all of this, the spike in global volatility, etc., mean for India? I mean, the market here in India has been driven almost entirely by local investors, right? And that is the bid under this market. Over the last 3-4 shocks, some mini, some slightly more than mini, the election, the tax change, the recent yen episode, market from high to low, the Nifty fell just 4.5% in local currency terms, the least amongst major markets. The question, though, is, does this delay, when foreign investors come back into this market, what's happening globally? What's your sense?
Definitely, local investors are not going to be an issue. We continue to expect domestic keeps on buying into the equity market, looking at their balance sheet exposure, which are still quite low on the equity exposure side. So domestic inflows, we expected to continue through SIP, lump sum, and NFO kind of a route. Talking about the global investors, it was very interesting during the budget time while I was in the US. Investors were disappointed to see that during the budget day, there was not a deep correction, because everyone was looking for correction to buy, was planning to buy into this correction or a dip of a budget if that would have happened. So what foreign investors are looking like, if any dip comes in India at a single stock level or at a sector level where the value is emerging, they will be buyer into that. And if you would have seen since election and take last 1.5 week out, there was a period we got close to $9 to $10 billion of inflow in Indian equities. That is an evidence that foreign investors are more than happy to cut down their underweights on India, go towards a neutral kind of a territory, but want to pick up sectors or stocks where value has started emerging. So that provides another set of a confidence to the investors that even in case if India is declining, a lot of money is still waiting on the sideline to enter into Indian equity markets.
All right, take that point. A lot of money is waiting on the sidelines to enter the Indian equity markets, and that seems to be the order of today's trading session so far as well. 15 minutes into opening, now we have the early rates which have settled in. The Nifty has actually recovered a fair bit from the lows, and the mid-cap index, that's really been the star of the morning so far. At one point was down by almost 0.75%, now down by just about 100 points, a tenth of each. And the story would also be clearer if you look at just the advanced decline lines of the last 15 minutes or so. When we started out, we had nearly, 3 stocks declining for every stock which was advancing. That moved on to closer to 2. And now those lines have come perilously close to each other. Just about 1,000 stocks advancing for about 1,300 stocks which are declining. So if the mid-cap index does recover, that tells you that maybe we're out of worries. A lot of these individual stocks surging. You have Trent, which has now made the highs of the morning. Apart from that, we're seeing increased traction on Coromandel. It was, I think, Sudarshan's 9 a.m. pick. So just pull up Coromandel International as well. And then you have names like Granules, Metropolis. The paint space, that's done well too. We had Berger Paints report numbers on Friday telling you that they saw the maximum amount of market share gain in a quarter this time around in the first quarter. That stock's done extremely well. Asian Paints too is out of the woods now, currently in the green. A lot of these cash market stocks seeing bigger moves as well. Real estate sector, we have Macrotech Developers up around 5%, Parag Milk up around 5%, Allied Blenders up around 5% as well. So we'll keep an eye out of the broader markets. Now seems like we've seen some bit of recovery from the lows, the broader markets recovering faster. Let's focus on ABB, which reported a strong set of numbers in the first quarter, CY24 as well. EBITDA margins coming in at a record high, expanded by nearly 526 basis points. And there have been a big surge in the profitability as well. Our colleague Vamakshi caught up with the management and began by asking on if they continue to hold on to the margin guidance that they'd given at the start of this year. Listen in.
Rightly captured that 300 basis points come from the internal efficiencies what we have derived so far. But of course, you should understand that this internal efficiencies also is driven by the volume growth which we are seeing in the market, right? And so that's something which is very important for us to sustain. So, and if that particular margin, margin, if you want to sustain, it's important that we have the volume growth also supporting it. So that's number one. And number two is, I think productivity is definitely a topic which is very important for every business. And they look at all options where they could be productive and improve their efficiencies in this particular journey, right? So I think it's a route of discovery every day. And so as and when people try to find out how they could unlock this particular value, right, to the shareholders and to the bottom line of the numbers, I think it should pretty much work out. But the question is there an end to this, or is there something which will deter this? I think it all depends on how the situation develops. And as the volume supports, I think the journey of discovery still continues.
Well, absolutely. And just a follow-up question on the margins. Now, of course, you have been importing tech and that is under the normal course of business. But what is the kind of royalty fees that you're paying as a percentage of your sales? Has it increased? Because we're seeing a rise in the other expenses. And, I'm just trying to understand here, what portion of this improvement in margins is being driven by localization as well as the pricing power?
I think pricing power is definitely on the external side of it. It's basically how the customers are willing to pay for the quality of the products which are the services what we're providing. And we have seen this actually going through a transformation journey in the market. So that's why we could see that also reflecting in the margins. That means people are able to pay and are willing to pay for the quality and the technology what ABB is able to provide. That's number one, right? And the number two is regarding how can we make sure that this actually is held together is again depending on the demand situation which is developing in the market. And we are sort of seeing a very positive view of it at this point of time, right? So with the elections and the budgets all done, so we have a stable government in at the center. So I think it's only the capex cycle which has to follow, which we are all expecting. So it's sort of unfold in the coming times. And coming to the royalty part of it, we pay 2.89 to 3% as royalty, 1% as for the brand royalty, which is called as trademark fees. So this is basically what we pay on account of royalty and trademark.
All right, sure. Thank you so much for that. And now coming to Mr. Sharma, ordering activity in the first quarter was rather muted, and of course it could be expected mainly on account of the elections as well as the budget that just got concluded. So would just like to ask you about the outlook going ahead. How is the pipeline shaping up now in the 4 segments that you operate in, and what is the conversion rate that you're expecting?
Well, thanks for having us. Well, as far as our 4 verticals are concerned, these 4 verticals have 18 business divisions. And our sense of having come out of election and the budget period is that the pipeline ahead is quite robust for us. And we operate with 18 divisions and 23 market segments. So overall pipeline for us, where our interest lies, it looks good at the moment.
All right, and order inflow in the first quarter was supported by large orders. So is this trend expected to continue going forward in the year as well? And do you expect the mix of nearly 40 to 45% of large orders in the overall order book to continue, or is there a change expected here?
Well, we do expect it because as far as the flow business is concerned, which we call as the fast-moving industrial goods, which are mainly in our electrification and motion business, which constitutes about 75% of our business. We do expect continuous strong flows there going forward. In the market segments, we see good activity. As far as the large projects are concerned, they come from the core sectors or major spenders like railways, metros, and they are not the ones which repeat every month, but then they keep coming every quarter or two.
All right, got that. And let's also talk about exports because they've seen a good growth of almost 39% this time around. And this is despite the geopolitical risk as well as the trade disruptions that we're seeing. So is this good growth in exports expected to continue? And it currently accounts nearly 10% of your overall share. So is this expected to rise further?
So our primary focus as a multinational corporation dedicated for India is Indian market, domestic market, and that's where we see maximum growth coming for us going forward, and we see the activity quite in favor of our portfolio. Now, our operations in the country, as I said, we have 25 factories and a fair bit of localization. They're increasingly becoming attractive factories for our global businesses, and they're increasingly giving the allocations of different markets to be served out of India. So we see this is a long-term story for us, and we continue to gain out of it. So different businesses have the mandate to export to different markets as allocated by our global businesses, and we see this trend will continue.
Sure. And, one last question to Mr. Sridhar, actually. So I know you don't give forward-looking guidance, but, revenue growth was definitely muted in first quarter as compared to, in the second quarter as compared to the first quarter and the previous year. But what would the top-line growth look like this year in comparison to the growth that we saw last year? Is it going to be at similar levels, or is the growth rate expected to be better than last year?
So I think when we look at 23, all right, you are comparing with 22, and 22, of course, comes strongly from the COVID period of 21 as well. I think the growth rate was very much faster and higher when you see 23 to 22. But when you look from 24 to 23, you're looking at a base which is very constant, which is 23 was pretty much very solid in that way. So in the 24, of course, we'll have growth. And I think we have been growing at a good double-digit number at this point of time, and we will definitely maintain that. I think if I want to allude on the topic of backlog, so our backlog, which is roughly around about 9,300 crores, is consisting of both large orders, which have an execution time cycle of a minimum of 15 to 18 months, and then you also have almost 55% coming from the short cycle orders, which have an execution time of 6 to 9 months. I think this has a pattern to convert itself, and we are sure that this will get sort of executed in the periods to come. And our aim is to make sure that we are there with a double-digit growth quarter on quarter. That's what we have been looking for. So this quarter, coming to this quarter, yes, we missed roughly around 150 to 200 crores of revenue. That's more because the economy was waiting for some important decisions followed by the budget as well. So that made the businesses to wait for an outcome of it, and therefore it was a more conscious call from the businesses to make sure that they are aligned with macro and topics to be there. So I think we see this as a momentary shift, and we are making sure that every effort is done to catch up with this particular slippage which happened in the second quarter.
All right. Thank you so much, gentlemen, for that conversation. That really cleared the air about the margins as well as the order outlook. Thank you so much.
Thank you. Thank you.
All right, that was the management of ABB. The stock down about 1.5%. Let's talk about another one, which is seeing a big up move. That's Inox Wind. It was a strong quarter for the company. Sharp expansion in the EBITDA margin due to superior sales mix. Devansh Jain, who's the ED of Inox, joins in now to give us more on the first quarter performance, but more importantly, what the year ahead looks like. Thanks a lot for joining in. First up, if you could, confirm whether this 140 megawatts of execution run rate continues through this year. What's the outlook out here? And margins as well. I mean, very strong, a little about 21%. Does that sustain? What are the levers here?
Hi, good morning. Pleasure to be back on CNBC. So as you know, Q1 was the highest financial performance in the history of Inox Wind. Our revenue was up about 85% and EBITDA was up almost 350%. Coming to your question on margins, look, we've guided for about 15 to 16% margin for the entire financial year. And obviously, there could be a slight upside to that as we move forward. But having said that, we continue to maintain our guidance at 15 to 16%. This quarter has been close to 21%, but I think in the course of the full financial year, we should be closer to the numbers I spoke about. With respect to the 140 megawatts you talk about, as I think is well known in the industry, Q1 is probably the lowest, Q1 and Q2, given that it's onset of monsoon, and Q3 and Q4 typically are the highest. So I would tend to think that Q3 and Q4 would be far larger than our Q1 numbers.
All right. Hi, Devansh. First of all, congratulations on a good set of numbers. You have been walking the talk, so that's good news from an investor's perspective. A couple of details I wanted. Are you facing some logistical issues? Because that's what some part of the street believes. Could you clarify on that front? And what is the breakup? This 800 megawatt is well and truly on, 300 in the first half and 500 in the second half. Give us some more details on that, on the execution.
Look, I'm not sure where this logistical issue question has come up from. We face no constraints whatsoever. Business is on track. We have publicly stated our vision to be a 2 gigawatt company in the near future. And I think we should be achieving that sooner than what is expected by most of the street. We've also gone on record to state that there is a fairly large upside to our FY26 numbers. While we've not upgraded the 800 and 1200 megawatts targets which we've set out for ourselves for 25 and 26, I think the order book in itself speaks volumes, and our current run rate of execution and profitability gives a fair amount of hint of where we are headed. With respect to your question of 300 and 500, look, we've stated our guidance of being an 800 megawatt supply or execution company this financial year. And I think we are very well on track to achieve that.
Got it, Devansh. So 15-16% margins, 800 and 1200 megawatt in the next couple of years, and no logistical issues. Part of the investor community had that query, so that's why I put it across to you. Let's get a couple of more details. Your current order book is around 2.9 gigawatt. Over what span do you see this getting executed? And also, if you could give us a sense of the commercial and industrial demand. Is that strong? If yes, should we be looking forward to some more announcements on closure of some orders?
Look, the 2.9 gigawatt order book, again, is the largest we've ever had in our history. Typically, this is something which we would execute in about 2 years. You typically get orders, private sector gives you orders which typically give you an execution timeline of about 12 months. PSUs typically give you orders where the peak execution cycle is about 24 months. And then you've got retail and smaller C&I, which would be about 6 to 9 months, within which I would tend to believe the 2.9 would be executed in the next 24 months. Again, I did mention that we are gunning to be a 2 gigawatt company in the near future. But again, depending on how fast and how large the Indian market is, we could see a much larger play out as we move forward. As we've announced in this quarter, we've already started setting up a larger nacelle manufacturing facility in Ahmedabad in Gujarat, which would enhance our ability to manufacture beyond 2.5 gigawatts of nacelles. So we are gearing up for the future. With respect to the CNI order book, I think we're seeing tremendous momentum, driven by multiple reasons. Primarily, of course, is that renewables is the cheapest source of power. Second, I think a lot of exporters, given that you now have CBAM coming up in Europe and eventually carbon taxes coming up in different parts of the world, particularly the developed countries, you would need green credentials and renewable power. And what's better than renewable energy? Moreover, a lot of the larger corporates are setting up their own platforms. So it's a win-win. They raise equity there. They create value on that front. The operating entities themselves, without any capex, gain significantly. We will be announcing a much larger play even within the Inox GFL group for our own captive renewable energy requirements. But I think the CNI market is booming.
Right.
We've announced about 600...
Devansh, just a quick word. In terms of acquisitions, I mean, Suzlon recently announced an acquisition on the OMS side. Will a lot of this ambition be via sort of buying companies? I mean, are there enough players in the market? I mean, that Suzlon, we spoke with the management of Suzlon. It was it was on the OMS side, and it was pretty small as compared to Suzlon's size. I mean, so just give us a sense of that. How much of this ambition is going to be via acquiring companies out there?
Look, what we're talking about is our Inox Wind, which is a manufacturing company supplying turbines. And on the CNI side, you're really supplying newer and newer turbines to take care of the incremental power requirements or the existing power requirements of thermal, which are being replaced by renewable energy. O&M is a different piece altogether. That's something, as you may be well aware, we probably have the only...
Devan, I was just using that as an example. Are there, on the manufacturing side, will there be sort of M&A strategy? Are you looking at opportunities?
Well, we are looking at opportunities, but that's more on the O&M side, not on the manufacturing side.
Okay.
I think at Inox Wind, we have the lowest cost structure. So I don't think there's anybody to acquire out there in terms of who could be value accretive to Inox Wind. But
so
yes,
just two-part question. Right.
a lot of acquisitions on the Inox Green side of things, where we expand our O&M portfolio.
All right, so just two-part question then. One would be on the acquisition itself. What is the size that you're targeting, if any, timelines, etc.? That's point number one. And secondly, you did briefly speak about CNI. If you could give us a sense of how big the market is, how big do you expect to be in this over the next couple of years?
I'm sorry, I could not hear you. I think there's a cross connection. Could you repeat?
Yeah, so can you hear me now?
Hello?
All right, you want to try this?
Yes, Devansh, are we audible?
Yes, yes.
All right, I think Mangalam has a query, but he'll get back with that one. I wanted to ask you about the interest cost. You know, on a quarterly basis, for the last few quarters, it's been in that vicinity of around 56 to around 65 crores per quarter. Now, for the past quarter, your PAT number itself was close to 50 crores. But as you'll have put in some money and you're virtually debt-free, if I understand correctly, that interest cost should come down on a quarterly basis. So from this 55, 65 crores per quarter, what does the interest cost come down to from quarter two onwards?
Look, I think we did mention we are now a net cash entity.
Yes.
And what's also been publicly stated is from Q2, our net finance costs should be negligible. So yes, you see a large chunk, you see 50, 58 crores over the past 2 quarters, but a lot of it also had to do with a lot of the repayments we were doing and a lot of one-time charges. I think for the full financial year, we've guided for net finance costs to be in the vicinity of 60 to 75 crores, which would entail a saving of almost 200 crores from the previous financial year. And given the fact that we are net cash now, I think this is behind us. I don't think finance cost is something which is going to be anything which is going to be really key. It's really going to add to the bottom line going forward.
Yeah, that's the reason I ask you that, because as of now, PAT as well as interest costs are almost the same. So that interest cost comes down drastically,
I think
then
that
will get added to the profitability.
I think that should virtually double, given that we've mentioned that interest costs from the next quarter should be negligible.
All right, final question then. I hope you can hear me now. Is because on the CNI business itself, you said that on O&M, you're looking at some opportunities. So if you could give us a sense of the size and the timeline that you're looking at in terms of any sort of inorganic plans there. And secondly, on CNI, how big are you planning to be here in the next, say, 1 to 2 years?
Look, first and foremost, on the O&M opportunity in Inox Wind, we had recently raised about 1,050 crores, which is primary. We are evaluating multiple opportunities as we speak, but we have a very prudent capital allocation policy. We will not buy out entities just them out or at numbers which make no commercial sense to us. We are looking at a very accretive business model under Inox Green, which is beyond just servicing turbines. We'll talk about that more as we in the coming months. But I think we are evaluating multiple opportunities. That's all that I can say at this point in time. With respect to the CNI market, look, I think, we're not married to CNI or retail or PSU or SECI tenders for that matter. I mean, at the end of the day, as Inox Wind, we're supplying turbines. Having said that, I think the CNI market is just getting larger and larger. So maybe a year ago, our PSU market or order book was almost 70% PSUs. Today it's down about 35%. We've strategically also diversified across multiple customers. We have 7, 8 very large customers. We intend to add about 3 or 4 very large customers in the near future. And I think I would tend to believe C&I should be about 60 to 70% of the market as we move forward.
Okay, all right. Commercial and industrial, 60 to 70% of the market opportunity out there. But as you say, of course, you go where the opportunity is. Thank you very much, Devant, for joining us. It's a pleasure. And good luck to you and your team as you continue to execute well. We'll take a quick commercial break here. I think the market's down, back down again, actually. So we're down about 140 points, which basically means we're at the day's low. And there is a lot happening. Market breadth is again widened. I mean, the gap between what's up and what's down, the number of stocks up and down, that's again widened. And there are these single stock accidents. We mentioned Sun TV earlier, but Bharat Dynamics is another one, sharp cut. I just want to add 2 or 3 more. Balakrishna Industries is down 7%. It's actually come off the lows of the day. Low was 27.50. It's at about 28.50. but it's still down 7 right now. That's Balkrishna Industries. And then look at something like a LIC, which has also come off sharply. It's down 5%. Reported numbers Thursday evening, and you heard from the management later on Friday morning. But stocks at about 1,080, down sharply. Astral, I mentioned earlier, that's another one. K Fintech had a sharp up move last 2 days. That is down 5,020 right now. And Honasa, of course, which again reacting to earnings, is down about 5%. Stocks at about 451. We'll take a quick commercial break here. We'll talk more about some of these names, the market, and of course we'll get back to that story in terms of the Hindenburg report. We'll have some experts join in to weigh in. We have Jayant Gupta, former ED, SEBI, and Sanjay Asher, senior partner at Crawford, Bailey and Company, joining in with their perspective on this matter. Stay tuned. Okay, welcome back. Let's shift focus back on the sort of news story of the weekend which came out. Hindenburg Research putting out allegations against SEBI chairperson on counts of conflict of interest and with regards to Adani Group and question to credibility in investigating the allegations against the Adani Group. Let's get in Jayant Gupta, former ED SEBI, who is joining in right now, and we'll have more experts coming on in just a bit. We have Sanjay Asher also with us on the phone line at Crawford, Bailey and Company. Sanjay and Mr. Gupta, great to have both of you here. Thank you for your time. Mr. Gupta, in a way, kind of unprecedented kind of news. This is a slightly unprecedented news story. The allegations being made against the SEBI chairperson, but responded to very fast and in a very detailed way. Your first thoughts on this entire saga, sir?
See, I am not surprised that there are allegations, because nowadays it is the norm that when you don't like somebody, when you have something, you start maligning the character of the person. So that is the norm nowadays. So don't be surprised, it is there. Coming back to the allegations and the rebuttal by Book family, I think it's fair, and I have no doubt that there is nothing, not even iota of truth.
Okay, I think the line froze, but he was just sort of opening comments. Sanjay, if you were with us, you can hear me. Good morning. Thanks for joining in. You heard a portion of course, what Mr. Gupta said, and we'll go back to him. But your first thoughts on this entire matter?
I agree with Mr. Gupta completely. It is absolutely character assassination and maligning the chairperson and her husband. They have amply clarified their entire professional career history, where they were, what were they doing, which territory were they, which jurisdiction they were, etc., etc. I don't want to get into the details, but to my mind, the clarification is self-explanatory. All the allegations they have denied, and I would completely believe them, keeping in mind their professional career, their stature, the fact that the chairperson has brought out so many reforms in SEBI, and she's absolutely passionate about getting into the capital markets and reforming it, which is why she left her private job and got into the job of a SEBI chairperson. So I have no doubt about it. And I'm completely with them in as much as that, yes, in all rightfulness, they've clarified everything. So there's nothing left in it. So it is some vested interest people, maybe in the market, inside India, outside India, some competition of Adani Group or somebody who has X to grind with Adani Group perhaps could have done that. But otherwise, I don't foresee any merit in what Hindenburg reports.
Of course, I mean, what is in a way, I think, according to me, a bit unfortunate is that it's also taken political color here in India. But Mr. Gupta, we lost you there. Please finish that point, sir.
So what I'm saying is very simple. When you look at the allegation point by point, it is something that I want to create a fiction out of nothing. And this thing is absolutely laughable, that in 2015 some investment was made when they were resident of Singapore, And in 2024, you are making an allegation that there was a co-investor Adani into that. Now, I am asking you a simple question. Do you know what is going to happen tomorrow? You don't have no answer. So in 2015, you will never know that, oh, I will become chairperson of SEBI in 2023 or 2022. There will be a Hindenburg report in 2023. Oh, I will be investigating that also. Oh, it will be against Adani. Now, understand very simple thing. I ask a very simple question. When you invest money in mutual fund, do you go and ask the mutual fund, give me the details of all the 1 lakh or 2 lakh unit holders, let me do KYC of them. Oh, is there Adani is a co-investor in mutual fund, so I will not invest. And I wonder that why everybody is saying that I have not invested in Adani. What is wrong with Adani? Is Adani some black sheep or something that untouchable? There has nothing been proved against them. Everything has been generated. So I don't know what is the untouchability about Adani also. So the issue is very clearly, you pick up somebody, you create somebody as a monster, and then keep on building stories around that.
Right. No, absolutely. Mr. Gupta, from a... So what is... You know, Hindenburg put out another sort of list of questions, etc. I think this was early morning, late last night. I'm sure you would have seen it.
No, I haven't seen anything.
Okay. So how should the... I mean, it's kind of more of the same, but how should the... What should the response be now? I mean, does anything more needs to be done, or the clarification is out? And that's about it. What should the way forward be, Mr. Gupta? Okay, I think we lost the line there again. Sanjay, you want to take it?
Yeah, I would say if everything has been clarified by chairperson and her husband, then it is fine. Then they only have to give a simple denial. But if at all anything further allegations have been made on their investments or on their financial position, then they have to just clarify that, and they say, okay, look, we repeat what we have stated earlier, and we deny all the allegations for reasons of not traverse. But otherwise, you keep answering Hindenburg where there is no meat in there or there is no truth in the allegation does not help, because the match will go on continuously then. There has to be some full stop or some punctuation mark at some point in time.
At what point does that full stop come? I mean, we're just trying to figure out if there is any legal recourse, etc. as well, Sanjay. Just
legal recourse. Yeah, legal recourse. If there is no truth, if there is no bit in the allegation, I would say they should file a defamation suit against Hindenburg. And there has to be some reform in terms of the likes of Hindenburg providing any report. And there has to be, government has to take action against Hindenburg, that any allegation they put, they try to destabilize the stock exchange, and stock exchange is the barometer of economy of any country. It's not only relating to SEBI or SEBI's chief. It is relating to the entire economy. There has to be some very strict disciplinary and stringent action. And they can't just keep reporting, issuing reports without factually finding out as to whether the facts which they are stating in the report are correct or incorrect. It can't be that they keep issuing report and we keep accepting it lying down. There has to be some action from our side in order to stop Hindenburg from issuing such reports and issuing further reports and further reports. It can't go on like this. So my point is that it is Mr. and Mrs. Bush should consider filing a defamation suit against Hindenburg. And two, there has to be some action from our side.
But where? Which jurisdiction?
I mean, we can consider jurisdiction whether in India, because it is affecting not only India but elsewhere as well. So they have to do this thing. Of course, the US law one will have to look at as to what the law is. But surely in India, because the report has been published in India and it is relating to her in India, so surely they can initiate defamation suit against in India.
Okay, all right. We'll leave it there for now. Thank you very much, Sanjay. I appreciate you joining in with that perspective. Mr. Gupta, if you can hear me, patchy line today, but appreciate you joining in as well. Thanks very much. Well, 120 points lower on the Nifty is what you have, 24,240. We are back, and we'll focus back on the market with some technical trades. Mitesh is going to be with us. Stay tuned.
Welcome back. 125 points lower on the Nifty. The mid-cap index has begun to sell off once again, down by about 0.75%. The first hour of trade trades at 10. Mitesh joins in for what he's made of the market so far and the stocks. Mitesh.
So, Mangalam, I think, it reaffirms that 24,400 is not getting captured in the short term, today's gap down, and the fact that the markets didn't try to go up and fill the gap. I think we'll take that idea of, maintaining some put options positions on the index and very likely suggesting a test of 24,000. And in case we start breaking below that, then another 200 to 50 point kind of a decline could happen. So the structure isn't turning positive with today's gap down being sustained. And on the stock side, I have one buy and one sell. Tata Power, I think, is breaking below swing lows. So keep a stop at 418. Look for a target of roughly around 396 over here. And the one which I like, I think, that's Granules, which has been running and which has been making new highs and still strong. So that is a buy with a stop at about 656 for targets of 685.
Okay, all right, Mitesh, thank you very much for that. So those are some trades coming through. PSU stocks, as we highlighted, names like Bharat Dynamics and Mishra Dhatu are seeing very sharp sell-off, 6 to 10%. Hormuz is here with what's going on. Hormuz, over to you.
It's been a trend over the last few sessions where PSUs have reported results that have mostly disappointed the street. It started off with railway stocks last week with RVNL and Ircon missing results, and we saw the impact on these stocks as well. And Bharat Dynamics today, the revenues for the quarter were down almost 36%. The profit almost eroded completely, was helped by some higher interest income. The EBITDA loss was also higher compared to the same quarter last year. So it was not a good quarter for Bharat Dynamics. Execution issues continue to hamper the operational performance of the company, and that is showing up in the stock price as well. Was down almost 15% at one point of time, has recovered slightly from the lows of the day, but still trading with losses of anywhere between 10 to 12%. Midhani is no different. Even here, the revenues were down 13%. The profit was down 70% from last year. The margins also saw contraction from 22% to sub 14% for the current quarter. So not good results for Midhani as well. That stock too is down 7 to 8%. And a trend among most of these stocks is, despite all of these stocks correcting anywhere between 20, 25, 30% from their recent record highs, they are still extremely expensive on the valuation front. Both Bharat Dynamics is down 30% after today's fall from the record high. Midhani is down 22%. But on a one-year forward basis, Bharat Dynamics still trades at 36 times compared to the 5-year average of 30. And Midhani also is trading at a one-year forward of 35 times compared to the 5-year average of around 32 times. And this is after a 20, 25, 30% correction from the record highs. So not good going for most of these PSU names, and Bharat Dynamics and Midhani are leading that fall today.
All right, thanks very much for that. So those are two names in focus, and we'll continue to do the same for other PSU names as well. But commodities are back in focus. Manisha is here with what's top of mind. Manisha, good morning.
Thank you for that, Prashant. I'm looking at the crude oil prices, where we did see the prices decline quite sharply in the last month, but that has seen a rebound. So we are off the 8-month lows, and the prices did gain 3.5% in the previous week. So after 5 weeks of decline, we've seen actually prices gain up quite strongly onto that one. It has to do with the positive economic data that we've seen come in from Europe and US. It also has to do with the more and more bets now and higher probabilities of the first rate cut coming in from the US Fed in the month of September. Apart from that, there are supply concerns from Libya's Sharara field, and there is force majeure declared there. And then there are reports suggesting that you could be looking at Iran retaliation on Israel in coming few days. Markets also are looking at the US crude inventories, which have continued to decline quite sharply, now at a 6-month lows there. So when you look at the crude oil prices for the month of July, we did see that huge range of almost $10 between 87 to 78 on the lower side. For the month of August, we picked up from 78. We did see prices go all the way to $80 in the first week of August, but currently we are holding around those 76 kind of levels there. When you look at the Indian crude demand, well, there are all reports suggesting that India will see the max or the highest energy growth marginally coming in going forward. So from 2014 at 3.23 million barrels per day of a consumption, we stand currently at 5.4 with an expectation that we could be at 6.7 by the time it's 2030. If you look at the past 1 week then, and we've seen prices gain up quite strongly there, it's not just about the crude oil prices, but coal prices are trading at a 13-week highs. We've seen 8.5% of growth in the last 1 month itself. Also, when you look at the last 1 week, the gains have been quite strong. Coal, for example, is gained up by 2%. Crude is up 5%. Strong 14% of gains is what natural gas put out. And we've seen 9% of gains coming for the gas prices in the matter of last 1 week itself. This week is going to be important because of two reasons. One, you have the Indian inflation numbers coming in today. And then you also have US inflation, US retail sales data also expected in this week. And the markets would react to that.
All right, Manisha, thank you very much for that. Well, we'll take a quick commercial break here. We are going to come back. Lata will connect with Suresh Ganpati, banking analyst at Macquarie, to focus on the first quarter earnings for the banking sector. Stay tuned.
Welcome back. Even as the banking results season ended with SBI, we got the global equities rout, which pushed up expectations of Fed rate hikes. And this was followed by a surprisingly hawkish monetary policy from the Reserve Bank. So at the end of it all, how are banks placed in terms of future margins, loan growth, deposit growth? For all these questions, I have with me Suresh Ganpati, the banking expert from Macquarie Securities. Suresh, welcome. Thank you very much for your time. Let me first start with what the SBI chairman Dinesh Khara told me on Monetary Policy Day about a simultaneous fall in bond yields exactly when deposit rates are shooting up. Just listen to him. I'm coming back to you.
There's a change in the interest rate structure when it comes to the lending. A lot of loans are being priced linked to the T-bill. And today, the way T-bill is behaving, in fact, the market is actually from that perspective, as far as T-bill is concerned, it's coming down. But when it comes to the liquidity issues, that actually forces banks to go for the higher cost of deposits. In such a situation, perhaps when RBI has said that they are concerned about the interest rate movement in deposit rates, I think it's quite justifiable. But I would say that there are various sub-segments in the market, and they're all getting priced differently.
Okay, Suresh, the long and the short of it is the banks are facing pressure on both sides. Irrespective of what the results were, is life getting tougher? Should we be prepared for lower margins?
Yeah, I mean, that's very clear, right? So he's saying that there is pressure on deposit rates, and you have seen obviously all these banks coming up with some special deposit schemes. And funding still remains a challenge. And even the Reserve Bank of India governor said that you have to come up with some innovative schemes to get deposit growth. So clearly, there is on one hand pressure on the funding costs, and on the other hand, obviously, you have loans which are priced off T-bills, priced off external benchmark rates and stuff. So that is also showing pressure. The latest data from the Reserve Bank of India very clearly shows, specifically when it comes to the public sector banks, the weighted average deposit rates have gone up, but the weighted average lending rates have remained flat of late. So that clearly shows that there is more margin pressures to come for the sector in the coming quarters.
Okay. So will you tone down your margin expectations even after the reports you wrote after the results? Especially now, let's start with SBI because the results came the last.
Yeah.
Are you going to bring down the margin expectations and even loan growth expectations? Because after all, the raw material has become expensive. Money.
Yeah. Look, I think, I mean, about 6 months ago itself, people obviously knew that there is pressure from the funding side, and therefore that will spill over to the lending side with respect to the ability of the banks to grow their balance sheets. So loan growth estimates have already been pared down. What I think most of the analysts, or for that matter, the market has got it wrong in our view, is the fact that we thought We have almost reached the bottom level of margins as of 4Q, but 1Q very clearly showed that margins continue to remain under pressure, and nobody expected, Lata, the LCR guidelines to come and take shape in the current format. Obviously, we know it's a draft guideline, but clearly the Reserve Bank of India is wanting to implement with effect from 1st April 2025. So before that, clearly banks will have to beef up their liquidity coverage ratios or realign, right? So either it means focus more on retail deposits or invest more in government securities, and that is the additional downside pressure to margins. So yes, across the board, for both PSUs and private sector, we do believe there will be more margin cuts coming forward in our view.
Okay. Your view on SBI itself?
We do have a sell recommendation on SBI. I think, Lata, what we are arguing here is that the ROAs have clearly peaked. There is downside pressure to the ROA coming from lower margins. And also, obviously, we will discuss this a bit later on the ECL norms perspective, whereby there will be some upward bias in terms of provisions. And we've also seen off late in the results, which we will discuss later, some signs of stress emerging across the board, right? So, so clearly credit cost normalization is only going to gather a little bit more amount of steam in the coming quarters.
Okay. Before I come to this, credit cost and the fact that unsecured loans have shown stress,
yes.
You wrote a note to that effect. Before that, let me first finish off HDFC Bank. They also stunned the market with a fairly high-yielding deposit announcement. I think 1 to 3 years, they give you now 7.35, which... Correct. If HDFC Bank gives you that kind of money, others will have to, at least match. So what is the expectation from HDFC Bank itself? Are you toning down their margins? What's the opinion on that bank?
Yeah. So look, I think they are in a peculiar state in a way, or, what has happened actually, of course, if you look at it, Lata, if you look at the ALM pattern, they do have large amount of borrowings maturing by the end of this year. And if I were to really compare the borrowings, the 1 to 3 year bucket and the deposits in the 1 to 3 year bucket, I think if they are able to garner deposits even at a slightly higher rate at about 7.4%, as we talked about, and the borrowings are coming in at 8%, or rather there are existing borrowings at 8%, it makes every sense to take those kind of deposits and replace the borrowings. And what exactly happens is they have an idiosyncratic issue which results in them actually having an ability to bring down their cost of funds, because their cost of funds is affected because of the merger. That's not the case with others. Yes. So in that process, everybody else gets affected a little bit more negatively compared to HDFC Bank. And therefore, if you look at this quarter itself, well, everybody else faced margin pressures. Their margin did go up by 3 basis points. I know it's a small number, but at least directionally it was good, right? So that clearly goes to show, Lata, that they are in a different situation, and therefore I think they should be in a position to maintain or in fact improve margins from current levels and report that 14-15% earnings growth that we are talking about.
Okay. Okay, now let me come to that unsecured loans note that you wrote. Who are the biggest casualties and who are the winners?
Yeah, look, I think, Lata, let's understand that there is no casualty as such, because we have to understand that these portfolios are very granular. The risk is also concentrated in specific segments in the unsecured space. It's not across the board, all ticket sizes. Certain pockets, certain geographies, and of course, certain stress on the credit cards portfolio. So what exactly happens here is that while there is going to be an uptick in the credit cost, it's going to be well within the manageable levels. The only problem here is what is getting priced in, right? So the first instance of some normalization levels of credit cost results in the markets getting a bit more jittery. I would still presume, even for that matter, PSUs we have seen, which has seen an increase in the personal loan delinquencies. Remember, for SBI, it is a very small, low-digit percentage of the overall portfolio. Same is the case with Bank of Baroda. So it doesn't move the needle in a very big way. But yes, the fact that you are running at 30-40 basis points of credit cost, even if you end up having 10-15 basis points additional credit cost, to that extent, it is negative on the ROA, earnings expectations, and of course, eventually ROE.
Okay. Well, banking stocks or the banking sector has been the underperformer of the market. So the market probably got it right. They could see that banks are going to be in for margin pressure, for probably asset quality pressure, even if it is marginal, and of course, technology investment pressure. Given this, what would your ranking be of banks? Who will be able to stem the tide?
So to a great extent, if you look at the numbers here itself, the private sector banks are still generating, despite this kind of an outlook, anywhere between 15 to 16, 17% kind of an ROE. Let's take that range, right? So, and the valuations are still very comfortable at this point in time. So even if you assume there is no further aspect of re-rating from current levels, 15 to 17% ROE can itself result in that much amount of power of compounding over the course of next I would say 2-3 years. So I would still stick with private sector banks. Also, the argument is narrative is coming from the fact that Lata, they are gaining market share on deposits. If you look at the deposit growth of both SBI and Bank of Baroda, it's been pretty weak in single digits. So clearly they're losing market share on that. There is a greater impact coming from ECL norms for the PSUs compared to the privates. The privates carry contingent buffers and provisions. So those are some of the advantages that the private sector bank has over PSU. So you're still sticking with the larger private sector banks at this point in time.
Okay. Let me quickly get the fintechs in and then come back to the banks if I have time. There are two fintechs you cover, 197 or Paytm and PB Fintech. Where are they in this whole picture? Are they better able to stem the tide of margins? Are they showing better business growth?
So definitely PB Fintech has been doing a better job in our view. Growth has been, of course, surprising us positively, continuously. In fact, over the course of last several quarters, they are gaining a greater market share in the segments that they're operating. One area where there has been a clear progress that has been seen is on the health insurance front, where very clearly growth levels continue to remain very strong. And they have a very small market share in the savings product segment. So coming off from a low base, they're doing pretty well. And interestingly, they've also been in a position to manage expenses and show operating leverage in their business. So in that sense, PB Fintech is, in our view, in a much better position. I still believe when it comes to 197, there are still a lot of pulls and pressures when it comes to the loan dispersal that they do. I still believe there's quite some time away before we actually start seeing reasonable amount of growth in that segment. And secondly, I'm still not very convinced on the regulatory and aspect, right? I mean, time and again, they have, of course, had these run-ins with the regulator, and therefore we need to get a little bit more amount of comfort before we actually begin to get constructive on that name.
Time completely, Suresh. One word on your best pick.
Oh, in the current environment, I'll still stick with the two largest private sector banks, which is HDFC Bank and ICICI Bank.
Okay. All right. Unfortunately, out of time. Thank you very much, Suresh, for rounding up both the macro pressures of Fed and RBI, as well as the regulatory rules and the earnings in a very short chat. That's the word from the banking analyst. We have to take a break and come back with Short Busters.